Welcome to our Easter Fixe on housing markets in Austria and the CESEE countries. I'm very happy that you made it here, and I see many known faces, so I already know now that the discussion will be rich. I also thank all the panelists who made it to Vienna, and I think we also have quite some online participation. So let's go for a very, very topical afternoon. We will talk about the housing markets in Austria and in Central and Southeastern Europe. You know that house price developments are always monitored very closely, especially in the current economic cycle. It is something where people are alert. They look at housing markets. If you have seen the last economists, some people even ask themselves whether the worst will still come, because until now, I dare say that in many countries, the development has been moderate, but maybe Laura will then correct me. And we really have the advantage of having good people today who will talk about this region and use a magnifying lens for Austria, neighboring countries, Balkan, Central and Eastern Europe. As we know, we look and stare at the housing prices because if they turn sour, they may impose financial stability risks to the banking sector. So via the household segment, they directly can develop a hit to the profitability of banks, to the credit risk of banks. And this is something which we will cover in 3 blocks. We start with where are the house prices going? So you will hear more about are they turning sour? Are they turning sour at all? Are they deteriorating rapidly? Is this already the end of the tunnel? Second session is then, as I mentioned, financial stability risks, because this is on our mind when we look at housing market. And from the last session, I expect that we have a wider view also on the society, because here we talk about something which is the affordability of housing. And I'm not aware of each single country in Eastern Europe. I only can say that in Austria, this is a hot political discussion. So I wish us all a very interesting afternoon. I'm confident that it will be interesting already looking at my first invited speaker here. Laura made it to join us here. Laura Valderrama is coming from Washington, IMF. She is transferring this summer from the European department to the Monetary and Capital Markets department, and she is an expert on European housing market. Please go and listen to her blog. She's also writing in some magazines on macroprudential policy. So she exactly combines this fact knowledge on housing markets with the wider ramifications it can have in financial systems of different countries. And she knows this also from bottom-up specific country experience. For instance, she was part Article 4 consultation with Portugal and Switzerland. So I think she has a deep knowledge, a very wide horizon, and she will be here to really cater for your interests, and she's the one you can ask all the questions which are on your mind. And with these words, I ask Laura to give her keynote. Thank you. We will, by the way, reserve some time for your questions.
Yeah, so thank you so much, Birgit, for this extremely kind introduction. And I think you try to raise expectations. I'm not sure I can address all the questions, but I'll try my best to give you some overview of the work that we have recently conducted at the IMF. And my remarks today are going to be based on some research that we have just published together with Patrick Gors, Marina Marinkov, and Petya Topalova. Okay, so what is the context, as Birgit was mentioning? So the first point is that since the pandemic, vulnerabilities in real estate markets have risen in many countries. And this is reflected in house price growth, accelerating beyond the pre-pandemic levels. However, at the same time, we have observed in the recent months that the increase in mortgage rates have started to exert downward pressure on house prices. And as a result, the risk of a hard landing or housing pricing crash has increased. Okay, so that's the first point. The second point is that against this backdrop, what we observe is that household finances are being overstretched, not only because of the rising mortgage cost, but also because of the increase in living costs. And this is casting a cloud over the repayment capacity of households to service their debts. Actually, banks in the region and across Europe, they expect that credit quality is going to deteriorate, and that's going to test the resilience of banks to absorb losses from increasing defaults. But also, from an economic perspective, we observe that many households are already adjusting consumption, and that could precipitate some slowdown in the economy, which could also have indirect effects on banks through adverse macrofinancial loops. So then the third point is that at the same time, we do observe numerous policy measures which are being implemented by governments across the region. And most of the programs we have seen were deployed to shield households from rising food and energy prices. But more recently, we are observing increased pressure on governments to also support highly indebted households to absorb some of the increasing mortgage costs. So let's begin by exploring these three issues. Okay, so the first message is that despite the recent cooling off, housing prices remain overvalued across the region, and housing affordability is falling. If we look back over the last 5 years, so between 2018 and 2022, real property prices have increased at around 20% accumulated growth rates in Austria and the CESEE region. And this represents around a double growth rate than observed in the euro area. Only Romania, as we see in the chart, has actually experienced a negative real growth. But then if we think about more recently, since the onset of a COVID pandemic, so as we know, until early or mid of last year, there have been some structural shifts that have supported house price growth. More importantly has been the increase in demand for space, but also some structural supply constraints, as well as higher savings rates by some of the households. But as we said, in the last few months, and depending on the country, so from, let's say, the summer of last year, on average, there is real clear signs of a housing market slowdown. But overall, if we think since the pandemic, so that's the blue bars in the chart, around 1/3 of countries in the region, so Austria and the CESEE region, have experienced annualized real growth rates of around 5%, which is quite substantial. And 2/3 of the countries have exceeded the annualized growth rate of the euro area, which is 1.3. So what does it imply then for potential likelihood of a housing crash? So what we observe is that over the same 5 years, a wide range of indicators are actually pointing out at overvaluation pressures, because house prices have grown faster than fundamental factors could explain. So here is 2 examples. So one is price-to-income ratio. So this price-to-income ratio in Austria, for instance, has increased over 30% compared to long-term average values. But in all countries, except in Bulgaria and Romania, we observe that the increase in the price-to-income ratio is at its peak compared to the last 5 years. So if we move to the price-to-rent ratio, which is another simple indicator of valuation, so we observe that across all countries, this price-to-rent ratio has been increasing over time, which means that it's increasingly more expensive to own property. And particularly in Austria, the price-to-rent ratio exceeds its historical mean by 3 standard deviations. Yeah, so this is the heat map shown in the slide. At the same time, there is a lot of uncertainty about the extent of overvaluation. So here we show a model-based estimate of overvaluation across the region. And this modeling exercise takes into account supply factors, such as dynamics in housing stock, but also demand factors, which is real incomes, real mortgage interest rates, but also macroprudential policy interventions. What we observe is that, as you can see in the chart, so across Austria and CESEE, the median country overvaluation has increased, and it stands around 15 to 20%. And this actually overvaluation seems to prove quite sticky over the last 2 quarters compared to other countries in Europe in which overvaluation estimates have started to come down. So what is our main concern when we see this context? So there are 2 main concerns. So one is that these rising mortgage rates are hurting housing affordability for new buyers. This is the case because we have observed a sustained increase in price-to-income ratios, but also there is a squeeze in real household income and these rising interest rates. So therefore, as a result, housing affordability is lower, and this can be measured by the size of the down payment at the purchase of the property, as well as the monthly installments, which is reflected in the debt service to income ratio. These latest developments in 2022 mean that across major European countries, the mortgage bill of a new buyer in the real estate market has increased around 1/3 compared to a buyer that entered the market in 2021. And if going forward, interest rates increase further, so up to 300 basis points, the mortgage bill will almost double. But also, these developments are a concern for the current household mortgage owners. And this is because there are quite many mortgage loans across the region which are subject to adjustable interest rates. So how important is mortgage debt in the region? So it depends on the tenure status. The tenure status, as you can see in the chart, it varies widely across countries. So for instance, in Estonia, Austria, and Slovakia, 1 out of 4 households, they live in the main property with a mortgage. However, in the CESEE region, 50% on average of households are outright owners, which means that they do not have a mortgage on their main residential property. But in these countries, in the CESEE countries, actually 1/3 of mortgage loans are not reflected in this chart because they are collateralized loans for consumer loans, which means that and also these households in the CESEE region, they are more likely to have uncollateralized consumer loans. So basically, in CESEE countries, 40% of households, on average, have outstanding debts. And this is worrisome for financial stability potentially, because 3 out of 4 mortgage loans in the CESEE region are actually subject to increases in interest rates, as reflected in the blue bars. But also in the CESEE, households spend twice as much as other households in Europe in essential consumption, which is food and utilities, which are also then subject to inflationary pressures. So turning to what could this development, and also going forward, what could this imply for financial stability and for the behavior of consumption? So as we can see in this flowchart, households are currently being subject to 4 types of shocks. One is lending rates, food price shock, energy price shock, but also inflationary pressures on other goods and services. Of course, as a response, household income is also increasing, but in most of the countries, it's not catching up yet with these inflationary pressures. So if we think about household vulnerability, how do we measure this vulnerability? So typically, what we do is that we use a metric which is called the debt service to income ratio, and we identify 40% as the benchmark which will define when a household, a borrower, is overstretched, so is at more risk of default. However, this metric does not account for the cost of living crisis, so therefore what we do is that we try to adjust this debt service to income ratio for the cost of living environment. And there what we find is that the critical threshold to differentiate between vulnerable and non-vulnerable households is 70%. So this is based on some econometric work, which will actually signals a deterioration in the rating quality of the household loan. So basically, when the cost of living adjusted debt service to income ratio exceeds 70%, the probability of default of a mortgage loan typically increases by 30% in the region, and the probability of default of a consumer loan increases by 40%. So, but we are also concerned about potential behavior for consumption. So there what we do is that we identify what we call consumers at risk, which are those households which cannot afford to keep the consumption basket because they would breach their income constraint. So then once we have defined the framework, so what we do is that we try to construct some scenario analysis to assess household resilience to different environments. And this is because there is a big uncertainty around the baseline forecast for the main macro-financial variables. So what we do here is we try to test the household resilience to our baseline forecast that was produced in October last year. And then we do generate 6 adverse scenarios. One critical scenario is the last one in the table, which we call cost of living, which is an intensification of the current cost of living environment in which there is a further tightening by 200 basis points, but also food and energy prices increase by 20%. So then what we find is that, in fact, the cost, so we find that this, as we mentioned, increase in mortgage rates together with inflationary environments could actually significantly stretch household finances. So, for example, if we think about CESEE countries, around 45% of households would be vulnerable under baseline projections. But this share would increase to 60% in our cost of living scenario. These households would actually account for 55% of all the outstanding mortgage debt and would also hold 50% of consumer debt. Of course, there is substantial heterogeneity across countries, depending on the nonlinear interaction between essential consumption, adjustable interest rates, and leverage. But what is quite worrisome is that the effect would be more substantial for low-income households, So in the CESEE region again, so what we see is that 3 out of 4 households low-income households are already financially stretched, but this share could increase to 90% under the cost of living scenario. And this contrasts with the high-income households, where only between 13 and 20% would be financially stretched under severe conditions. So what we have found is that not only the current conditions and adverse deterioration going forward could increase the risk that households default, but also it's more likely that they are forced to cut back on their spending, as we mentioned, because they are breaching their income constraint. And what we find is that specifically one out of 3 consumers could be forced to cut back on spending under baseline conditions, but under the cost of living scenario, there could be 50% of households that need to reduce consumption. So what does it mean in terms of the amount of consumption that they will reduce? So we find that on average, they would reduce 7% of consumption, but low-income households would decrease 14% of consumption, so twice as affected as the average consumer. So if we think about financial stability implications, so certainly banks in the region, they are exposed to household loans, both mortgage and consumer loans. And some of the countries in which the banking systems have a higher size of mortgage loans, and also they have lower regulatory capital, they are particularly exposed. So these are the countries which are in this pink shaded area. Okay, so what we find is that if we think about the impact on the banking system of this deterioration in household finances, so what we find is that the results depend on whether there is a soft landing or there is a hard landing for house prices. So if there is no house price correction, the impact on banks on average is quite manageable. So it would reach around 40 basis points in some cases. However, if prices revert back to fundamental value, which was around 20% correction, so the impact on the banking system could be quite significant for some countries, most notably Slovakia, Latvia, Croatia, and so forth. So, okay. So then the final point is that what is the role of policies to shield households from financial distress? So as we mentioned, governments across the region have rolled out quite many schemes to tackle the cost of living crisis. So in Austria and the CESEE region as a whole, so governments have earmarked around 1.9% of GDP to protect both firms and households, and 1.3% of GDP just to shield households from the cost of living crisis. As we see, however, on the right chart, most of these measures have been untargeted, so they have been in the form of food or energy price caps that benefits the whole population. Okay. So at the same time, as we know, so there is a call for to shift from broad-based policies more to adequately targeted policies. And actually, we're discussing with Birgit that our first Deputy Managing Director, Gita Gonipath, yesterday in her speech in Sintra at the Monetary Policy Convention, so she actually really emphasized that whenever necessary, we need to target policies. But here the question is, how do we target policies? How can we make sure that actually benefits some of the vulnerable households? So here what we do is we try to calibrate 3 types of illustrative policies which vary on the degree of targeting. So broad policies would shield consumers from rising energy and food prices. And this is denoted by subscript 1, so it's on the northeast of the chart. And then we have partially narrowed targeting policies that would shield the bottom 2/3 of the income distribution, and then narrowly targeted policies, which will just protect the bottom third of the income distribution. We also, for Croatia, we look at the actual policies that they deployed, and this is denoted by number 4 for Croatia. So what we observe is that for Austria, which is depicted on the blue line, so you see that the slope is quite high, so quite steep. So this means that the most cost-effective policy in Austria would be to really target narrowly the fiscal subsidies. So in fact, if we were to do that, so that would be number 3 in the chart, this policy would save 6% of financially stretched households, and the cost will be quite limited at around 0.6% of GDP. However, for most of the countries in the CESEE region, they do have flatter curves, which means that the most cost-effective policies are generally medium-targeted policies, which also protect some of the medium households. We also conduct some simple cost-benefit analysis from financial stability perspective, which tries to look at what is the outstanding debt that these financially stretched households are holding. And what we observe is that there, for financial stability purposes, policies that target the low income but also the medium income are the most cost-effective. And then finally, we try also to address the question that there is, as we mentioned, some increasing interest in protecting borrowers from rising interest rates. And here we did some calibration also for the cost-benefit analysis of some actual policies that were recently deployed in Portugal. And there we see that one of the policies is renegotiation of loans for distressed households. And there we see that the reduction in mortgage debt at risk would achieve around 3% with the conditionality which is shown in the slide. And the cost of policy for the banks would be between 10 and 15 basis points. But also in some cases, also governments are providing some interest rate subsidy. Here again, what is key is the eligibility criteria that in principle should be quite tight. And there again, we observe that 1% of mortgage debt at risk could be decreased with a very small amount of 60 million estimated fiscal outlay. So just to wrap up, so I focused the discussion on the key risks from the recent developments in housing as well as the cost of living crisis. And we see that these developments are stretching household finances, which could cause households to default on their loans, but also to cut back on consumption. At the same time, it's heartening to see that under very mild house price developments, most of the banking systems are resilient, but still continued vigilance is warranted because the likelihood of a crash, housing prices crash, has increased. And then we see that we argue that the rollout of fiscal policies should be really targeted. And this task is not easy because we need to really calibrate well the policies to avoid weakening the monetary policy transmission, as also to contain fiscal cost. So I'm very much looking forward to a very stimulating discussion on all these critical issues at this very important juncture. Thank you so much.
Muchas gracias, Laura. It was a very rich setting of the agenda of today. And thank you also for being so careful about really already delivering data of each of the countries to interest of us. So we already went into this region deep diving. And you took a lot of care of defining what is a vulnerable household, how much is at risk. And I particularly like that you integrated it already with the current cost of living crisis, which we have. So this is a very real life and very useful introduction to our afternoon. Thank you very much. We are already at the end of the first slot, but I would like to take 3 short questions, if there are any, to give Laura the possibility to react to what you want to know. So, I see 1, 2, 3. And if you could shortly say who you are, it makes the discussion even better.
My name is Michael Klein from a research institute here in Vienna. I just wanted to ask about the loss in affordability that you mentioned. I mean, the high inflation is also good for debtors, and so I was wondering if the still negative real interest rates somehow cushion or dampen how large is the loss in affordability really for people taking up a mortgage at the moment?
Let's collect the 3
Okay,
questions.
yes, okay.
Franz?
Franz Nauschnick, formerly OeNB. My question is, the IMF has just recently published that the inflation rate is mostly driven by rising profits of companies, more so than by rising raw material prices or energy prices. So wouldn't it be a good to bring this down, for example, by taxing profits higher?
That was not really the topic of today, but I leave it up to Laura, whether she wants to discuss it over a coffee with you or she wants to react here. The 3rd question, please.
Ulrich Morowitz, University of Natural Resources and Life Science here in Vienna. Obviously, there's a correlation between ownership and costs for decarbonization. And given the international targets of cities and countries, did you factor these future costs into your analysis, or what is your take on how this would influence your predictions on defaults?
Also very challenging. Laura.
This is really a very stimulating workshop. I mean, it's just more than I dreamed. Okay, so the first question, thanks a lot. So, so the chart that we presented on affordability was like for new buyers, so that they would not benefit. It's not outstanding borrowers, so they would not benefit from the decrease in the, in the outstanding debts. Yeah, so it would be. What would be as we said, the down payment and the monthly installments of a new buyer. And of course, there we take into account our projections for price and income developments, for new buyers. For outstanding borrowers, so certainly they do benefit from the fact that some of the outstanding debt actually is at fixed cost and their incomes are growing. So this is really taken into account in the analysis. So it's mainly the ones that are adjusting within the next 2 years that are really losing affordability for their monthly payments. On the second question, right, thank you. So yes, okay, I really have to think a bit more like on the coffee break. But certainly I think that the IMF was mentioning, that at least, they could, try to absorb a little bit, some of the increasing wages that we are observing. So there's so much, I think there's not so much like discussion on profits, but more like in absorbing the wage increases. And the third one on ownership, so that's also a good point. No, we have not included that, and actually that's an interesting question also for macroprudential policy, as Birgit was mentioning, because what we see in some countries, they do have like green mortgages, so of course they try to favor or to decrease the relative cost of green, relative to brown mortgages. But that actually would certainly, depending on the type of mortgage, could actually increase the cost, but in some other cases could actually alleviate. So we can discuss further. Thank you.
Thank you, Laura, and I hope you will not disappear quickly so anybody can still catch you on more issues. Thank you, and I would like to hand over to session number 1 on housing prices.
Take up where Laura has left us. Thank you for this very stimulating and informative keynote. Warm welcome to the first session of this workshop. Today we will discuss this really topical issue of housing markets, also because they seem to be at a turning point. As we have also heard by Laura's presentation, house price growth has moderated recently, both in Austria and in the Central Eastern and Southeastern European region, which we call CESEE for short. In Austria, the residential property prices declined at the end of 2022 for the first time in several years, when we measure it as compared to the previous quarter. So in the first quarter of 2023, according to this measure, they remained flat. And in CESEE, house prices growth moderated in the whole of the second half of 2022 as well, after also a very prolonged period of strongly accelerating prices. But still, you should not forget that, especially in CESEE, and I think this is what you made very clear now, Laura, the house prices and also average house price growth still continues to be higher compared to the EU average. But more generally, not only prices are moderating, also the dynamics of housing transactions and housing loans indicate a cooling off of housing markets across the whole region. So why do we see this moderation? So there is a high level of uncertainty, certainly, and also the increased cost of living, which is dampening demand. On the other hand, financing costs have accelerated due to the interest rate increases, and hence all this has weakened demand for housing. At the supply side, also maybe a shortage of material and equipment, as well as, in CESEE particularly, shortage of labor, may be burdening the construction sector, therefore also adding to some moderation. I would just like to point out, and if you could put up this, thank you, that we have today released our latest property market review. You have here a QR code which you can scan to download it, or you go to our website and you will find it. And here you find more information on these recent developments, both in Austria and in CESEE, and also deeper analysis, including also the financial stability implications. But this is the topic of the next session. So in this session, we will touch upon also many important questions. And let me now turn attention to the three excellent speakers I have here in this session, and listen to their main messages. So I'm very happy to welcome Katarzyna Jędraszewska from Erste Group here in Vienna, Adam Bonaj from Magyar Nemzeti Bank, and also Michael Klien from the Austrian Institute for Economic Research, the WIFO. Katarzyna, I will just briefly introduce all three speakers now, so that I don't have to interrupt their important messages later on. So Katarzyna is the chief macro analyst at Erste Group Bank. Her expertise lies in the economic developments of the whole CESEE region, so very broad topic. Prior to that position, she was also country specialist for Poland, where she comes from, as you can probably deduct by her name. And she has studied in Prague, CESEE, so she is really, I think, a very good expert of the region. Adam is Executive Director for Monetary Policy Instruments, Financial Stability and Foreign Reserve Management at the Central Bank of Hungary. He received his academic degrees from the Corvinus University in Budapest, and he joined the Financial Stability Department of the Central Bank in 2008, where he climbed up the ladder quite quickly, I would say, to reach his current position in 2020. He's also a member of the Financial Stability Board in Hungary, and closer to our topic today, he's also a member of the advisory board at the ESCB Europe Institute for Real Estate Finance and Management. And last but not least, Michael Klien is senior economist at WIFO. He is working in the research group Macroeconomics and Public Finance and the research group on regional economics and spatial analysis. Since 2014, he has these degrees from the Vienna University of Business Administration and Economics. And his research also covers very broad areas. But we invited him here today as the expert on construction and housing at WIFO, where he deals intensively with questions of the construction economy and the affordability of housing. And without further ado, I would give the floor first to Michael to talk on Austria and a very particular aspect also concerning measurement, as I understand. And then we'll turn to Katarzyna to give us an overview and give the final word to Adam to dive deeper into a specific topic. Please, Michael. Sorry, no, one more, sorry. All the presentations will be available on our website at the end of the event.
Thank you for the kind introduction and the invitation to talk here about recent house price developments. I think this was the title of the invitation. And first, a disclaimer, maybe at my research institute, actually, house prices were not a main focus or target that we were monitoring very closely. We left this to the Nationalbank, which publishes regularly very interesting reports on this. But since the topic is getting more and more attention and is potentially more important for the macroeconomy, so our interest has increased in recent months, and so we have started ourselves to gather data, to look into the data, and I will present only very simple descriptive statistics as we see it in data that I will be presenting shortly. My focus here actually is on the narrative. So I think to go forward and to understand what is happening at least in the Austrian real estate market, this is my focus. I think it is important to understand what is driving what is happening now. So I will really just take my time to clarify at least how we see the story and the narrative, what is happening in the Austrian real estate market, housing real estate. We have started to collect data on listing data from a large, or they self-proclaim it is one of the largest real estate platforms in Austria, ImmoScout24. We have scrapped the data already for several years, but now we asked for their permission, and they were kindly enough to agree that we can use it for our analysis. And as I said, we just use this data and what we see on the online platforms, what is going on to tell our story of the Austrian real estate market. So I know, of course, or we are very aware of the drawbacks of listing data compared to transaction data, and I will not talk about this. Here I will focus on the advantages, and I think the advantages of this data are very evident at the moment, because on the platforms we see the transactions that are not actually taking place, and we see the mismatch between supply and demand that we have in the Austrian real estate market at the moment. So I think looking at least also at transaction data is very interesting. And one of the main takeaways is already on the first graph, where you see the number of listed units over time, and you see quite spectacularly, at least from my point of view, how the number of units that is available for sale online has increased. This is true both for apartments but also houses, and it is important to see this is a countrywide trend. So here we have just subsampled the different Austrian provinces, and you see very much the same trend in all Austrian provinces, wherever you go. Maybe more pronounced in some provinces than in others, but over the board it is the very same trend. So this is important I think to stress. There are stories around circulating that in some regional markets like Vienna, there was an oversupply or overbuilding. I'm very skeptical of this appraisal, but this is not what is driving the real estate market at the moment. We see it in all provinces, no matter the different supply side factors or how much housing supply reacted over the last decade. In our story, it is evident that macroeconomic factors lowered demand, or macroeconomic and macroprudential factors. The dominant one, in our view, are interest rates, but we also see a role of the strengthened or more stringent lending standards in Austria that have been introduced in August 2022, and these are the driving factors that are creating what we are seeing here in our data. I think the collapse in demand in Austria is very visible due to these factors. So if you don't believe our data, there are some secondary data sources that you can go look at. Transaction data for tax data, which shows already in the fourth quarter 2022, we had a reduction in the transaction volumes by 10%. This has even, this is doubled in the first quarter 2023. So this is very consistent with what we see in our data. So what we have printed here are only slightly smoothed the data from the online platforms. If you differentiate how long listings have been active and on the market, you see time on market increases. It increases very strongly. So on average, actually, it has doubled from 30 to 60 days mid-2022 to beginning of first quarter of 2023. So this is really corresponding to what we hear from real estate agents, that they are having a much more difficult life to get rid of their objects. So you see this. So part of the overall increase in the market is not because new supply is entering the market. It is really that listings are on the market a longer time, and so the stock on the online platforms is aging. Maybe interesting for us, we still have to do some data cleaning to confirm this, but what we also see is that beginning of 2023, actually the share of new units entering the market, so the yellow part of the graph, actually this is decreasing. So we are still trying to understand this. There are several speculations from our side. Sellers wait and see because they know the market is more difficult. Maybe also that there are bargain hunters out there. So once good or at least cheaper units enter the platform, they are immediately sold off or bought by someone. So there is some ambiguity. We don't know how to understand this, but this is a relevant thing in our view. And last but not least, prices. Of course, when you talk about the units that we see on the platform, so very simple, what we looked here, median square meter prices for Austria on the long view. And I think this is very much consistent to what the Austrian Nationalbank is publishing. We saw steep increases after Corona pandemic, and we see stagnating or a sideways movement at least since mid-2022, maybe even earlier, maybe immediately after interest rates started to increase. So there is a decline in real prices, but at least from a nominal or what we see in the listing prices, there may be higher reductions than earlier, but we see a sideways movement. In our view, there are just, and this is my last remark, a few open questions, and again on the data side maybe. So for us, an interesting future question would be actually which units remained on the market. The more stringent lending standards make it more difficult for, I would say, lower income households to buy new property. So the question is, do we see higher transactions on higher priced or more expensive units, or in which direction is this bias or the still transacted units going? This might also even affect the transaction prices that are collected by Statistics Austria. So we saw that they saw still increasing real estate prices, at least until the end of last year. So maybe this is a side effect of a selected sample of units that are still transacted at the moment. So this is our narrative, what is happening in Austria at the moment. Thank you for your time.
Thank you. if you had put that line way back to 2009 or 8, 7, I think we would have seen even more clearly how this is leveling off now. I think we will come back to questions then after the other two presentations, and I would like to hand over to Katarzyna, also literally the pointer.
Thank you very much. I'm honored to be here and shortly to talk about the impact of recent shocks prices on price development. So also some summary of statistics and some kind of simple plain calculations we've tried to make to look at the costs and the impact of the recent interest rate increases. So actually this is something what we've already heard from the beginning. That in over last 2 years, the average annual growth has been very, very, very dynamic. It went up almost exponentially. What I would like to just put into perspective, we divided the growth of house prices into 3 periods, so 2010-2015, so shortly after the crisis. Then between 2015 and 2020, the prices started to grow. At the very beginning, very gradually, but they started to take off over last 2 years. So when we take a look at the average annual growth between 2015 and 2020, it is half what we have seen over last 2 years. So this is a major change, which we attach to a couple of the factors. So very low interest rate at the beginning, the pandemic came, and there was even more monetary easing. There were post-pandemic reallocations, so the demand was very, very strong. A lot of people tried to search for the bigger houses, so one missing room for home office. And obviously, the supply side also played a role with the pandemic breaks in the construction, the increase in costs of materials. Probably all of that contributed to such a dynamic development. It has also been mentioned that over last half year, the prices cooled down, but it's very heterogeneous over the region. And I don't have it on the slide, but we saw a negative growth rate in the fourth quarter of 2022 only in Czechia, Hungary, and Slovakia. In Poland and Slovenia, the growth dynamics slowed, but it's still positive. And in Croatia, it actually accelerated. So when we take a look at the region, on average, it really did slow down, but you see the heterogeneity within the countries as well. After pandemic, another shock comes. The war in Ukraine breaks, we have surging inflation. There was a massive monetary tightening. These are some obvious facts, just to show how much the interest rate on new mortgage loans increased in the region. They at least doubled between December 2021 and 2022. And as it was mentioned by Laura, the shocks are combined. So this is not only increasing the interest rates, but we have also increasing costs of living. This is something what definitely overall cooled off the demand, made household to cut on the consumption. So since then we have saw a visible decline of new business volumes in CEE. And these went dramatically down by at least half in such countries as Czechia, Slovakia. Just anecdotal thing in Poland, the recent crisis also opened a discussion about having variable rate versus fixed rate loan. That's something what considers also financial stability. In the country, in Poland, more than 2/3 of loans are variable loans. So households there were very, very, very sensitive to the timing of the of monetary tightening. And Poland was one of the countries where the increase in the interest rate on new mortgage loans was also the highest. Hungary, I think it's quite obvious, it had the highest effective interest rate in the region overall. And then we have, I don't have a Croatia on the slide, but Croatia, Slovenia, Slovakia, they fall into the ECB policy already, so the interest rate increases were much smaller. So we did a simple exercise. Does it work or? Okay, no. So we did a simple exercise. We look at the average price of the per square meter on a primary market. We calculated how much 50 square meter apartment would cost in a respective year, and we took the average interest rate on new mortgage loan. This is ECB data, so that's the respective data I showed on the previous slide. And we assume that you take a mortgage for 20 years, which is, let's say, probably the one of the most standard timing. So between 2021 and 2022, the increase in nominal installment was the highest in Poland, and this is also related to the fact that there is a variable rate. In Croatia, Romania, Slovakia, the increases were the lowest, and this actually reflects the massive monetary tightening that began already in 2022. But we also took a look at the share to average wage. So what you can see on the right-hand side, the share of mortgage installment to average wage ratio increased between 2021 and 2022. But for 2023, what we would like to show here is that if you keep the interest rate at the same level, and let's assume that the prices do not grow, but your nominal wage will grow, which we already see in the CEE at least, around 10%, then you are kind of coming back, releasing the burden in 2023. So this is just an illustrative. Before I move to the last slide, which is probably most interesting, that we are not that pessimistic and tend to think that the correction will be most likely short-lived. Let me maybe explain what I mean by correction on the house prices is that we do not expect such negative growth or stalled growth as it was between 2010 and 2015. Probably the growth dynamics will cool off, but not necessarily to a great extent. And here I would like to just mention a couple of points. Also maybe in relation to the financial crisis in 2009. And for us, the key change or key factor is that the labor market conditions are totally different. Unemployment is at the lowest level, so you don't have the worries about losing a job. And that's a structural issue. You have a very strong nominal wage growth, and here I put it on the graph, correlation between nominal growth of average wage and growth of housing prices. These are annual numbers for the whole region between 2015 and 2022, and this was one of the strongest correlation among all macro variables. So inflation, GDP, and others. So the correlation with the nominal wage is something important, and in our view, the expectation about your nominal wage and not losing a job may be also a significant factor that will not necessarily lead to a more or a bigger correction on the market. Apart from that, we are entering the period of monetary easing. The expectation will be rising, so we also think that the central banks in the region reached the peak. We do not expect any further rate increases. And there are also some other factors that, at one hand, should ease the demand, so this is the end of post-pandemic allocation, but there are also strong inflow of migrants from Ukraine. This is particularly true for Czechia, Poland, Slovakia. That will definitely also have an impact or had an impact on a market. And then changes in regulation Some are some are also supporting the demand. Here, let me make a last point about Poland that introduces 2% fixed rate for new buyers, for the first buyers. So this is something what will be kind of fueling the demand in the country. So this definitely is different country by country. Czechia stands out as the most expensive country. And from the long-term point of view, we will definitely look at the population growth, also migration, but the climate change, flexible working arrangements will also play a role how the market will develop. And definitely there will be also a difference between primary and secondary market impact. So yeah, I'm probably running out of time, so let me leave you with these thoughts, and then we can come back to the discussion. Thank you.
Yeah, thank you for giving this good and detailed picture on the CESEE housing markets. Hungary stood out in terms of price growth, if I remember. So Adam, what's behind this?
Thank you very much. Thank you for inviting me. I put together many slides, and I should be very quick, so you can find all of them on the homepage, and probably going a little bit deeper in. And I will talk about 3 topics shortly about what was the last year, what happened in the last year regarding the housing market, what is happening now, and I will talk a little bit about the new aspect of housing, which has probably a strong influence on the prices. We have seen some influences already. And for sure, the others covered a lot of topics, so probably it won't be new, or not everything will be new. So how did we get here? The last 3 years, it was very interesting and a very changing environment before, after the end of the global financial crisis, especially from 2013, we had a huge rising phase of housing prices for about seven years. And after the onset of the COVID, or the start of the COVID, there was a very short stagnating period, which was a reason of uncertainty, and also a reason of some physical limits, like you could not really physically look for new houses because of the reaction on the COVID. And after the COVID, there was a new boom phase, especially in Hungary. And last year was the last 2 quarters of 2020 was a short declining period. And what we see in 2023, so this year, is more like a stagnating period. So probably it's time of turn, but we cannot be really sure from these 3 quarterly data. And what we have seen after the many years of booming period is that there was huge overvaluation in these countries, and it is worth to little bit differentiate between parts of the countries, since most of this huge overvaluation is happening or happened in the big cities, especially in the capitals. And it was true not just for those big European cities which everybody's know about, like Paris or London, which are very expensive, but for cities like Prague, Bratislava, or Zagreb or Budapest, compared to the income levels, these cities became very overvalued for the locals, especially. And if we go to a little bit deeper to Hungary, there is also a huge deviation between different parts of the country, as the big boom period was especially characterized by characteristics in Budapest, and all the other big cities had a huge increase in the prices, but it wasn't this important in the smaller settlement like villages. So there is a big divergence between different type of settlements. And all in all, in many European countries, because of this big price boom, the ESRB made a warning because price movements went hand in hand with strong lending activity. Although the structure of lending activity was very different country by country. For example, in Hungary there is a strong LTV and PTI limit, and also it is important that in the Hungarian case it is very opposite to what we can see in Poland, because most of the loans, so 97% of the annual issuance of the loans are fixed rate mortgages, and it means that fixed for 5 or 10 years or so. So where are we now? What is happening now? In the last 2 quarters, we have seen some decrease in prices or stagnation in prices pretty much in the whole EU. And we don't really know what will happen in the near future. I will give some thought about it. But what it means, or what is the reason behind it, probably partly the lending. Although what we see is that the changing cost of borrowing, so the bigger interest rates, is probably not the main driver of lower lending. If you compare the different countries, the change of mortgage interest rates was very different country by country, and the change of new disbursement of mortgages are mostly negative, no matter what was the change in the interest rate. So what we think is that behind this phenomenon is the reason that a very strong driver of this change in new mortgages is the uncertain environment, uncertain due to inflation, uncertain due to the geopolitical tensions, and for sure one part is the tight monetary conditions, but not probably not the big explanatory variable behind that. So what is happening with the overvaluation, and I will focus on Hungary in this case. What we see is that due to the decreasing price in the last 2 quarters of 2022, the overvaluation of Hungarian flats, housing, decreased by a lot. The overvaluation, what we estimated, was around 25% before, and today it is around 10%, which is a huge drop. But what is the reason of this huge drop? It's mainly that we have a stagnating, nominal stagnating price, and still we have a very strong labor market with a very strong salary increase. So if we focus on just these macro fundamentals, we can see that overvaluation decreased. But if we put the interest rates, so the lending conditions in the equation, the picture is very different. And due to the high interest rates, the affordability of housing didn't really improve after all. So this increase of salary with stagnating nominal prices didn't result a more affordable housing market due to the tight lending conditions. So it suggests that probably some further adjustment will happen. The question is how the further adjustment will happen. And my idea is what we see is that there is a big decrease in the number of transactions, so we will have a less active market, which suggests that there won't be a big price decrease, but more like a longer-term stagnating price with low number of transactions, probably higher bargaining power for the demand side, but not a huge fall in prices. And also what we have to keep in mind is that on the cost side, there is big inflation in construction prices. So it also means that the new houses which will come to the market, the prices will be high due to the costs. So there is no room for adjustment in case of new houses. It also suggests that after all, new houses and old houses have to converge all the time. And for this reason, I don't think that this cost part will let a huge adjustment in prices in the near future. And as I promised, I have just a few slides on a very new aspect on the housing market, which is energy efficiency. And why it is important. In the Hungarian case, about 1/3 of all the energy consumption are made by the households, actually by the residential real estate, so it is a huge part. And what is very unfortunate in case of Hungary is that the consumption of houses didn't really improve in the last 20 years, although in many other EU countries there was a huge improvement. But still, it is a very important factor in energy consumption, which has a sustainability aspect. It also has a kind of political aspect since we had an energy crisis in the last year. And what we realized in the last year is that for about 10 years, energy consumption of houses was not a question in the Hungarian market, since there was strong subsidy in energy prices towards the households. But in the last year, it has changed due to the energy crisis and the jumping energy prices. And all of a sudden, in just 2 quarters, there is a significant difference between the price movements of those flats which are energy efficient and less relied on the changing energy prices towards those which has lower energy efficiency or more consumption. So it means that probably energy efficiency will be a higher or a stronger factor in the movement of housing prices in the future, which can be very important, not just in Hungary, but probably in other countries as well. And it will make more heterogeneity in the market. So until now, the biggest driver was the location. Today, energy efficiency is as important as the location. And although we can see that consumption by the households became much lower during the energy crisis in Hungary, and it was true for all the other countries, I'm not very sure that it is sustainable, which also underlines that probably in the future, energy efficiency will be one of the most important drivers. So thank you very much for listening to me.
Thank you to all 3 speakers for giving very much food for thought and for discussion. I just want to ask first the panelists if there are any comments you would like to make to each other before we give the floor to the audience.
I just wanted to confirm that none of us is expecting a large correction in housing prices. Yeah. Yeah.
Probably a bit bigger, stronger in secondary market than on primary market, but we have also seen in the data the evidence that also partially anecdotal, but when you look at some portals that some developers on the primary market take this wait-and-see strategy.
And just to add, in nominal terms.
Yes.
So in the real terms, for sure, in this inflationary environment, there will be an adjustment.
Well, thank you. Are there any questions or comments from the audience? Please, Karen and Jan.
Yes, Karin Wagner from Austrian Central Bank. What I wanted to add on this price discussion, what we saw with the index, which we do calculate together with data science company, together Austrian Central Bank, that the price corrections which we see and which we saw concerning that there is a difference between higher price flats, and the same is also for houses, than for the median price flats. So this is also important for vulnerability discussions. Higher price properties develop at the moment, at least, when we go back for 5 quarters, in a different way than the average price of flat and houses. So, and this gives us also the bridge to, okay, these households are more or less with higher price flats, also those with higher incomes, and therefore maybe less vulnerable and so on. So maybe with my message is, with all these price discussions we had also, as Adam said, with the gas heated flats, that there is a difference. There's also a difference whether there's a high or median price. Thanks.
Thank you. Maybe we can collect a second comment by Jan Klatschko.
Thank you very much. My name is Jan Klatschko. I'm from the National Bank of Slovakia, and just wanted to ask one question about the role of institutional investors, because it was not mentioned. So if you see any role in these Austria or CEE countries of not like households buying houses, but the institutional investors that can be present on also the residential market. Thank you very much.
Who would like to start? Katarzyna?
Well, I personally didn't explore who is behind the transaction, so we were just looking from the side of from the price approach. So this is hard to say, but in general, like if I think about also kind of investment type buying, if that's what you're aiming at, then definitely in the region it plays a role what kind of structure of home ownership versus rental you have, right? And the attractiveness of buying it for the investment for renting. That would probably like in Poland, if you had such a high flow of migrants that were looking for the renting the place, that probably could be an encouraging factor to buy for the investment purposes, especially the rents went up. Yeah, Prague speaks for itself, I believe, for everyone. So yeah, these kind of factors may definitely influence, but we didn't explore. This is just an opinion.
So regarding the differentiation or the heterogeneity between different type of houses, yes, we agree. We usually try to go as deep as possible based on the data, and what we also see that different districts within Budapest may have different price movement for sure. The downtown area, which is a very expensive area, usually has not just higher prices but more stable market. But this is also true for areas like Lake Balaton. Balaton is a big lake in Hungary, is very popular for holiday reason. It's usually have more stable prices. So there are this type of differences. And what I have shown as well, in the small settlements in the villages, which are not very popular with versus labor market position, versus services, etc. Market movements are usually on the upside. It is lower, the dynamic. On the downside, it is usually faster. And regarding the investor types, so I think in the whole region it is true that the rental market is not very regulated, which personally I believe is a problem. But as a result, institutional investors are not appearing on these markets. And what we see in Hungary, that most of the investors who are active on the residential market are households or household type of investors, so private individuals, probably wealthy, who can buy 10, 20, 30 flats, but but not thousands as a normal institutional investors. What is a bit new that there are some investors who are active in the Hungarian market in construction, building new houses. Some of them started to build from themselves, and they are buying 100, 200 flat buildings and rent it out. But these are few companies, I can say 2 or 3 companies are doing something like this, more like they want to have some experience on this market, so it's not a start of a new trend.
To Karin's comment, I cannot really answer this. We've not been able to analyze this, but that the different segments are affected differently would also match previous experiences. So yes, we would like to look into this, and maybe we come back to you once we have had the time. And for the institutional investors, I had a meeting with my boss and representatives from institutional investors recently, and actually my takeaway of how they see the situation is actually they are waiting for bargains to be made at the moment. So they are ready to buy, and they wait for house prices to go down. So large insurances and others who want to add units to their rental stock to have a relatively stable fixed income. Some question was just from part of these institutional investors, because apparently now they're under higher pressure to actually rent out the apartments, which it was easier to finance to actually just have them in the stock and not actually rent them out. Some of them said they might even have to reduce rent, so maybe which scared them or was unexpected. So we don't know, but there is going on. Investors are not selling their units. This is not the impression that we get. They have a lot of cash available, and they want to invest. So this is also a reason why we don't expect a big drop in prices, because there are buyers ready waiting at the sidelines to pick those up.
At the top, probably supply will also drop in 2022. There was already lower number of building permits, so that will be both combination of demand factors and the supply side as well. If that will be lower, it will probably keep the growth dynamics a bit higher. Yeah.
Thank you. We have a comment or question from the online audience. Please, Teresa.
Yes. To what extent the price indexation rules for real estate renting in Austria influence a very mild real estate price correction, regardless of the lower demand and excessive supply, at least in Vienna?
So I think the question goes probably to you.
Yeah, another stabilizing factor, I think, for house prices, because if you consider the decision to buy a house or not as a trade-off between renting or buying, having inflation-adjusted rents always keeps increasing the attractiveness of buying. And now with new construction collapsing or something close to it, also in Austria, I think rents will stabilize as few new units enter the market that the next years. I think this is clear. So I think that the two are affecting each other, and in the rent adjustment with the CPI is stabilizing house prices, I think, in this case.
Are there any further comments or questions? Yeah, Franz, please, and Andres also. But let's take Franz first.
It seems you rely mostly on on correction of overvaluation on inflation. What if inflation goes down stronger than expected, so that you do not have this correction? And second, if you look historically, usually if you had such an increase in interest rates, you usually had a correction also of prices. And if the forced sellers, which are now trying to sell but not selling, but if they are forced to sell, then this could have a big influence on prices.
Yeah, please. Yeah.
I mean, my logic would be you already had a high inflation, high interest rate environment. If it falls and the interest rate falls, then kind of affordability or burden release. You have totally different eligibility for the new loans. This is something also what has been reducing demand over last year strongly, that suddenly some households, due to very high servicing costs, do not have a space to take a new loan, which will change if inflation falls and the interest rate falls, right? So that will be something actually in favor that the correction is not that strong, because then the demand would kind of recover, at least in that setup. So that's something what we would actually probably see more or less happening. Question is to what extent we definitely expect interest rates to go down next year.
Just one thing to add. I think not inflation itself is important, but the wage increase, which is a little bit the reason of. So inflation is a little bit a reason of wage increase, but I think because we have a very strict labor market, not just in Hungary, but in all around, I think wage increase will be fast in the future, even if inflation will decrease. And also this strong labor market means that the need for fire sale in case of homes will be very low. So the supply side will wait for better prices, and this is why I said that I'm expecting the number of transactions being low for probably on a longer horizon, but with low price correction. So the correction will be in the number of transactions and not in the prices.
Okay, Andres Semionov.
Yes, Andres Semionovs, Bank of Latvia. First of all, thank you very much for a very interesting panel. I have a question regarding this observation that you saw a decrease in the activity and to some sort also to prices for these energy inefficient housing and those that are heated by gas. In your opinion, do you think it's a transitory trend? Is it just related to gas price as soon as, I don't know, we cannot forecast that, as soon as the gas price goes back, it's there again? Or do you maybe think that it's some longer structural trend, maybe something also thinking about the environmental goals, etc., that might last longer? Thank you.
So I think these type of shocks usually has a longer term effect on the behavior of households, and probably it's a far example, but maybe supports my idea in this, is that when we had the FX loan crisis in Hungary, it had a very long-term effect on the behavior of households in borrowing any money. The Österreichische Nationalbank has this Euro money survey, and in the Euro money survey, I think even in 2013 we have seen that those who had any relation to FX loans don't really want to have or to borrow because of this bad experience. So 5 years later, and this relation meant that if they had FX loan or in the family or among the friends, so even fire relations very important in this survey. So it suggests that this type of shocks may have a long-term effect on behavior, and for this reason, probably renovation, changing energy consumption, applying solar power and this type of stuff will be important in the next years as well.
One last question, please. But please wait for the microphone, and meanwhile.
And banks will be really eager to give a green loans.
Yeah, Nicola Brandt from the OECD. I just wanted to reinforce Adam's point, because I do think, so it's not only the shock, I think the gas price shock that we've seen because of the war. If you think about EU policies for building standards, for decarbonizing the building sector, it has to be the case that uninsulated homes and homes that are heated by gas, right, they should drop in prices, because it will be very expensive to refurbish. So interesting development to watch.
Actually, when Michael in the beginning mentioned this, which units remain, and I think you will look into this, but my question would be that will these energy efficiency considerations play a role here, or what would you expect on that?
Yes, I agree on what was said before, and I mean, we had a look at listings and the headings of the listings. Actually, you could see that throughout 2022, more and more listings came up with they have a Fernwärme, so a remote heating system, or they have alternative energy systems. So this is more and more entering, I think, valuation of homes. And I've been to a meeting of I don't know, the profession that actually estimates the value. I don't know how you call them in English, but actually they have really big textbooks on how to value and evaluate a property, and more energy-related questions and things are entering their textbooks. So a new generation of bookkeepers and people who evaluate real estate is growing right now, and so I agree with your prediction. This will have an effect on valuations.
We're a bit over time, but a final word.
Just because we were kind of thinking about the climate change as well, and like trying to think in also kind of broader perspective, like the new generation comes, they are also with the mindset about more green focus sometimes, but they also have a flexible work arrangement. So I personally think that will also have an impact on the structure of the housing market. Where do you start buy homes? Because we all live in the cities, but maybe it will not be that nice to live in a city in 10 or 15 years. And someone who is young now or have a parents, maybe they think similar things. So maybe some kind of deurbanization will start to happen, obviously, if there is a space for that. So there are kind of different factors that may fall apart together as well, right? So it's better to live outside the city. I don't need to go to work. So you maybe will move out from the markets. That will be easing or helping the market here. But on the other hand, increasing the house prices per se or building somehow. So just yeah.
Thank you, although we all know that it's more energy efficient to live in the city. Thank you for this great discussion, valuable inputs. All the slides will be on the website, and we will have a coffee break now and continue with financial stability, considerations, and affordability after the break. So enjoy the coffee.
Okay, so good afternoon, everyone. Welcome back after the coffee break. So we will start session 2 dedicated to financial stability risks. Are housing markets back on the agenda? First of all, I would like to welcome our two distinguished speakers, Ms. Frauke Škudeni and Mr. Miroslav Pašil. Originally, we had to have 3 distinguished speakers, but unfortunately, one speaker got ill, so at least we will have a bit more time for discussion, hopefully. So please feel free after the presentations to be active, because I think it's a very interesting topic. Maybe first of all, a few words about our speakers. So Frauke currently leads the real estate team of the ESRB Secretariat and is a co-chair of the Agile team on borrower-based measures for commercial real estate loans. Before, she has been working at the ECB in different areas, but I'm not going to mention all of them because 1 hour is not enough for that. You can check it on the website. She was working on topics such as international trade, commodity markets, and so on and so on. She holds a PhD from Catholic University in Leuven. And Miroslav joined the Czech National Bank in, may I say, in 2005. It doesn't look like. And he's an expert in the field of quarterly financial accounts. Since 2011, he has been working in the Financial Stability Department. He has been in charge of the Real Economy Unit since 2018 and became the head of the Macroprudential Analysis Division in 2023. He also served as an advisor to a member of the bank board. He holds a master's degree in econometrics and statistics and a PhD degree in statistics from the Prague University of Economics and Business. Before I turn to the presentations, maybe just a few introductory words as we have a bit of a time. So as we have already discussed real estate quite a lot, so maybe just to start from a different angle, I realized that in the past recent years, I have a feeling that I'm from Slovakia, and in Slovakia, we have experts, or everyone is expert on 3 topics. First is sports, so everyone is expert in football and ice hockey. The second, since 2009 and 2020, is COVID, so I have a feeling that we have 5 million doctors in Slovakia, and the third is real estate. And I think that's not by accident, because if you check Slovakia, we have one of the highest home ownership. Based on the last HFCS data, I think the home ownership rate in our country is 90%. This is because of different reasons. So we have, as a heritage of the past regime, when everyone was granted a place to live at. Also, like we have discussed during the previous session, Slovakia also belongs to countries with underdeveloped rental market. It's also connected to mobility. And of course, this affects the demand for housing, which is really, really very high. And you also see it on the data. So basically, currently, every 4th household has a mortgage loan, which maybe at the first glance seems not so huge, but if you take into account that mortgage market started basically in Slovakia in 2004, 2005, most of the young households have a mortgage. So it's also a very important topic from a financial stability perspective. We are closely monitoring this also because the mortgage loan portfolio has currently a share of almost 40% of the overall bank balance sheet, bank's assets. So it's really an important part of the bank's balance sheet and can be an important source of credit risk. Also, this is the reason why the central bank introduced a lot of borrower-based measures in the past couple of years. We have measures like loan-to-value, debt-to-income, debt service-to-income limits, and this is, of course, because they are not supplementary, they are complementary. So they are targeting different risks and different types of households. So this was also hopefully helping us to get to a stage where, hopefully risks are under control. But now, of course, when we see this increasing interest rates and increasing inflation, it's again a big question how to deal with it, how to assess it. And I think there are 2 layers of this problem. The first is that at least currently the accumulation of the financial stability risks stopped a bit. So now that we see that the mortgage market is going down and the demand is a bit contained, at least risks are not accumulating at a pace what we have seen before. Of course, the second question, whether the risk will materialize or no. We did some tests. I don't want to bomb you with numbers. We have released the financial stability report just recently, where we assessed that, okay, so until the labor market is stable, probably there won't be any huge losses. But of course, this is just our assessment. So, and now we can probably hear that was the assessment of the other colleagues. So I don't want to
waste any more your time and would like to ask Frauke to present the view of the European Systemic Risk Board. So Frauke, the floor is yours.
Thank you very much, and thank you very much for the nice introductions and for having us here, of course, also. So I will take the perspective of the ESRB, basically looking at Europe in total, but I'm sometimes also digging deeper into the countries. What I would like to do is to show a bit how we conduct our analysis, and of course also to try to answer a bit the question. At the start, I can already say the second question which you asked, whether it's back on the agenda, I can just say it's the whole time on the agenda because we are monitoring the risks on a permanent basis. So let me see. Yeah, that's the right button. What is obviously on the mind of all of us currently is that we are in the presence of some shocks. First of all, of the inflation shock, inflation going up, real disposable income going down. And then, as a consequence, we have higher interest rates. That has a bearing on the housing markets, house prices risk going down because of the interest rates, but also because of the household income. So that's from the shock side. On the lower part of the chart, you see the vulnerabilities, and that's what we are monitoring on a regular basis. We have actually published a report in February last year on these vulnerabilities, looking at the EEA countries, well, at the EEA as a whole, but then also at individual countries where we saw vulnerabilities. Those which we identified mostly were house price overvaluation, household indebtedness, which is quite high in a number of countries, less so in the CESEE countries. I will come to that later. We have observed loose lending standards in some countries and a high share of variable rate loans, which is obviously, as we heard also before, a vulnerability. On the other side, we have some resilience factors currently. We have relatively high savings ratios, and that's partly related to the pandemic, where consumption was relatively low because nobody could consume what they wanted to consume. And we have labor markets with low unemployment. We have scarcity of labor in a number of areas, which is in some way also a resilience factor because it keeps up household income. On the other side, of course, on the supply side, that can pose some problems. So taking both the shocks and the vulnerabilities together, the whole situation could lead to a higher probability of default and loss given default on RRE loans. Could lead to credit losses on mortgage loans, could reduce consumption also in a second round effects, and both lower consumption and also possibly turning down of the housing markets, resulting in lower construction and macroeconomic effects could lead to credit losses on other loans. So that's more from the financial side. To show you a bit how we analyze real estate markets, we distinguish between different stretches. The first one is the collateral stretch. That's basically when we look into residential real estate prices, into the price-to-income ratio. We have heard about that from Laura earlier on, and into different measures of overvaluation. The second stretch is the lending stretch, where we look at loans to households for house purchases, both the stock of loans but also new loans, and the household loan spread. And the third one is the household stretch. It's about household indebtedness, household financial assets and how far they can cover the debt and the debt service to income. Taking these stretches or these analysis of vulnerabilities together, we look into the situation in the cycle, and that's particularly relevant at the current juncture because when we drafted the last report, all the countries had almost all countries had increasing prices. So we were in an upturn of the cycle, and then we could just say, okay, here we see low risk, medium risk, or high risk. Now we are really in a situation where for some countries, there's still a continued expansion. Some countries have a slowdown in the markets, have a correction in the markets, or even a turning point. And that makes, of course, a big difference. And taking all this information into account, we then come up with an assessment on whether risks are low, medium, or high. To illustrate that with a bit of luck, you will see some charts, but only, yes, okay, there we go. Nominal house prices. So what we have done here is we look first of all at nominal house prices here, while in our report previously we always looked into real prices. That's just because inflation was having such a strong impact on the nominal variables, or on the real variables, that we decided, let's first look at what happens on house prices and not on inflation. On the left-hand side, you have a chart with annual growth rates of house prices. I took here the CESEE countries plus Austria plus the euro area. The green dot is in fact the observation in the second quarter of 22. Most of the time it was shortly before the interest rates started hiking. I ordered the countries also decreasing from that moment onwards. And then you have afterwards a red dot, a yellow dot and a blue dot going on each time 1 quarter, which means basically you see that the dots in most countries are going down, meaning that price growth has decreased in annual rates of change. They still remain positive on the left-hand side. You see that in Q1 they are way lower for those countries where we have Q1 data already. When you look on the right-hand side, we have done the same thing, but on quarterly rates, where you have a bit more of the short-term dynamics, and there you see that the quarterly rates of change of house prices went already into negative territory for a number of countries. If I would show you the same chart also for the non-CESEE, non-Austria countries, you would see there are quite a few more in negative territory. Loan demand, that's on the second stretch I mentioned before. Loan demand is also declining. On the left-hand side, we have in yellow the stock of loans, which went down slightly or stabilized somewhere around 3.5% on average for the euro area. But I also show new loans, and what we observe there is that the year-on-year growth rate is very strongly negative for the euro area as a whole and for almost all countries in the EEA for which we have data. So this decline is really very strong. On the right-hand side, we see a bit the reasons for this decline. We have taken the data from the bank lending survey of the ECB for the euro area this time. There you see, first of all, that the actual demand, I don't know whether I have a pointer. Maybe I have a pointer. No, you wouldn't see it here. Well, anyway, you see that the green line is the actual demand, and that has come down quite a lot over recent quarters. The violet line is the expected demand, so it is expected to remain rather negative. And you see that the contributions, so the bars, are mainly coming from the impact of the interest rate, from the impact of the housing market prospect, and also from the impact of consumer confidence more generally. And this is something we observe actually when we look into individual countries as well. Looking into household debt, and that's why I mentioned the CESEE countries are a bit different. I put the CESEE countries more on the left-hand side, and the other countries on the right-hand side, and you see there's a big change in the levels. So the household indebtedness is relatively lower, much lower in the CESEE countries than in the other countries, where household debt tends to be quite high for a number of countries. We also put here the debt service to income ratio. It is not the debt service to income ratio which we get really loan by loan, but it's an aggregate based on BSI statistics. And obviously it is somehow correlated also with the overall level of debt. And one thing which I found quite interesting also, I think it was mentioned in one of the previous or several of the previous presentations, is the share of variable loans. That's the dots here, the red dots, which varies a lot across countries. At the same time, I don't find a strong correlation with the borrowing costs, which normally you would probably expect, because each time when someone has a variable loan, the reaction to interest rates should be stronger. Something we need to, and you would see a similar picture probably if you would take the other euro area countries here, just put the aggregate. It could partly be related to the fact that the share of variable loans is a clear definition, but the share of fixed loans depends not only on it's not only the fixation of the interest rates, but you need to know how long they are fixed, and that makes a big difference in terms of the impact on borrowing costs. And unfortunately, we don't have the data here on that. Now, turning to the macroprudential policy side, because what I talked about here was really just the vulnerabilities, we look then at the other side and how far macroprudential policies help to remediate the risks which we have identified before, and we do that again country by country. There are a number of countries, and here I focus on the changes since our last assessment, which was at the beginning of last year. There are a number of countries who continued building or rebuilding capital buffers, for example, by increasing this, the CCYB or introducing a sectoral systemic risk buffer, like Bulgaria, Czech Republic, Croatia, Hungary, and Slovakia, and Slovenia for the sectoral systemic risk buffer. And a few countries acted also in terms of borrower-based measures by adjusting the calibration of existing measures, like Poland, Slovenia, Romania, and Slovakia. And what we then do is we have first the risks, which you see on the left-hand side, then we consider the policies, and taking both into account, we assess whether we see the policies as appropriate and sufficient to address the risks. This picture actually addresses a bit the initial question you had, whether real estate or residential real estate is back on the agenda. We have very high uncertainty currently, and we believe it is very much related to the outlook in how far any risks can materialize. We have currently an environment of high inflation, monetary tightening, and decreasing households' disposable income. And then we distinguish here between a baseline scenario and an adverse scenario. In the baseline scenario, we say there can be an orderly correction, which we currently seem to observe, which is bringing down the level of accumulated risks. And that could be beneficial in terms of financial stability, obviously, when we reduce the vulnerabilities. It could also be that the situation evolves such that the economic growth picks up, that the situation improves, inflation moderates, and the vulnerabilities could start building up again, house prices could start increasing again, and that obviously would require some readiness to act in terms of macroprudential measures. In my opinion, less likely but still possible scenario would be an adverse scenario with a disorderly correction, which could be followed by a materialization of risks. And if such a scenario happens, obviously there are a few countries who are more exposed to this kind of risk with high household indebtedness, a high share of variable loans, and so on. So that was just to give you an overview of that. The last slide is about CRE. Why do I talk about commercial real estate here? I mean, we have mentioned it. I think we have touched upon it, institutional investors and so on. Residential is part of commercial real estate. The definition of commercial real estate is that it's not held by households. But still, you have quite a large share of investors who are also purchasing apartments or houses. Well, more apartments than houses, I would say, or houses with apartments included. And that's why I think it would be very interesting also to look a bit more into that. On the left-hand side, I show you total commercial real estate transactions based on a private organization called RCA. And you see, in fact, the part which is interesting for this talk here is really the apartments part, so the blue bar on the bottom. And you see that indeed there's a decline in transactions. What we normally hear and read is that the transactions partly also went down because there's this wait and see attitude. So that could be part of the story. I think we discussed that a bit before. But this is what we currently observe in the data, and we are looking into that going forward as well. It is something we observe across the different components of commercial real estate, but apartments are definitely affected as well. On the right-hand side, you see the rate indices. Unfortunately, we don't have good statistics on CRE prices. We have lots of statistics, and sometimes they are going completely into opposite directions, so it's really hard to work with that. But we are very often looking into rate indices, which give some indication of the expectations. And you see quite nicely this blip down in all the components and all the sectors with the COVID crisis, which was more an expectation, which for residential then didn't happen as we saw in the data. But we see that then afterwards, mid-22, with the interest rate increase, we had indeed a decline in these prices as well. And I think the last one is just a summary slide. So house price growth has decelerated, turned slightly negative in some countries, but there was so far no substantial decline. It is likely that there will be further corrections, we think. It depends very much on the economic outlook. But we also have some dampening factors, like, for example, low housing supply. That's actually a very important factor as well. Labor shortages, and which are keeping up employment and wages. But still, we think that in an adverse scenario, more could happen in terms of financial stability implications. And we have a very large heterogeneity across countries. And that's all from my side. Thank you very much.
Thank you very much. So just as in case of the previous session, we are going straight to the next presentation. So Miroslav, the floor is yours.
So thank you, Jana, for your introductory remarks. Also, I would like to thank organizer for having me here and for the opportunity to supply with some information about the recent Czech experience. But let's jump right into the presentation because the time is quite tight. I would like to touch upon three main areas. First, I would like to tell you something about the recent developments, on the RRE markets. A lot of information has been already revealed to you, but maybe I can supply you with some recent trends that go beyond official statistics, or the statistics released by our statistical office. Then I would like to sum up some current risks, financial stability risks that are associated with these developments, and what was the macroprudential policy reaction. And if there is some time left, I also would like to cover some analytical tools that we actually use for assessing the risk, because this is the necessary precondition for, let's say, sound policy making. Okay, so if there is a spot somewhere on the globe where you should have been really worried about the price developments, so the Czech Republic is definitely one of those spots. There are some others, but Czech Republic is really a place where you should have worried about the recent developments in property prices, because in the last 10 years the price is actually more than doubled, and similar to other countries, actually the real party started after the outburst of COVID-19, where actually the government support that was poorly targeted actually really contributed to some households to become really rich. At the same time, the interest rates fell really to technical zero, and monetary policy rates dropped to almost to zero, and the BBM measures at the time were deactivated. So this poisonous concoction or combination actually led to real party, and we observed double-digit growth on the property market, and in 2021 and the first half of 2022, like the growth exceeded 20%. And everything actually came to the end in the mid-2022 due to enormous increase in the monetary policy rates, which are right now at 7%, but also as a supportive role due to reintroduction of the BBM measures. As you can see, the prices reached their peaks somewhere between Q2 and Q3 of the last year, and they have been falling ever since, on average. There are a huge heterogeneity across regions. There are some regions where not really attractive and where the prices fell by more than 20%. And there are some also property, let's say, types that are more vulnerable to price declines than others. Notably, those inferior flats, apartments dropped quite considerably. When it comes to the new houses and new buildings, it's kind of difficult because the developers really do not want to emit a signal that the prices are falling, but there are some hidden ways actually how to tackle this issue. They actually, like the price on the contract is still the same, but they offer you another parking lot or a kitchen cabinet or something, which is a hidden way how to actually make it more cheaper, but like the price is remains the same. Sometimes they also help you with mortgage financing, so they like artificially decrease like the interest rates, which are now really high. But anyway, there has been a really heterogeneous reaction across different segments, and but overall we think that we are already few quarters behind the peak, and we think that we are close to the trough. It means that the price correction was quite orderly. On average, it could be about 5%, or maybe in some segments 10%. But we think that in year-on-year terms, the growth will return to the positive territory in the next year, and the growth will remain positive, although muted in the second or in the years to come. Along with this price growth is observed in the past, what we observe also is that actually the estimated overvaluation of apartment prices grew enormously, but in the last quarters it actually starting to drop. Okay, if you're asking whether the let's say usual suspect, which is easy and cheap debt financing was there, yes, it was there. Like all the price growth was actually fueled by ever increasing debt. So you can see the volumes of the new mortgages almost tripled or doubled, tripled, and it was enormous. And it only fell after the monetary policy tightening. Maybe I would argue that actually the interest rates are actually one of the key drivers for the prices that cause prices to fall, and also limit another issuance or provision of new credit. Of course, the reaction is really asymmetric. It means that when the interest rates go down, it is very quickly translated into prices. When the interest rates go up, so it may take some time, and the reaction may differ from country to country depending on other factors. But in the long run, I'm completely persuaded that actually the interest rates were the main driver why actually the prices started to stagnate or drop in some segments. And along with the increase in debt financing, we also observed like the deterioration in credit standards. It means that the ever higher share of mortgages were granted at more, let's say, risky terms, and it only returned back to normal after the reintroduction of BBM measures. So let's say that our case actually confirms the general lesson when there is a low interest rate environment and no macroprudential policy reaction, then these credit standards actually tend to deteriorate. Maybe in our case, surprisingly, this only relates to those income-related indicators. Banks were quite cautious in recent times, and they did not provide like the risk loads in terms of LTV. There was no reaction in terms of LTV, and they also sort of tightened the credit standard implicitly because, let's say, at the very beginning and at the start of these exorbitant times, for banks, the price or the value equaled the transaction price. But in recent quarters, we already observed that actually the value that they use for the appraisal was lower than the transaction price. So there was an implicit tightening, even though the share remained almost intact. So what does that mean like for the overall assessment? We have observed enormous accumulation of cyclical risk in the recent past. That they mainly related to the developments on the in the property prices market and also mortgage market. But the risk or we think that we are already behind the peak of the financial cycle, so the risks are now slowly being receding from the mid-2022. The interesting thing is that usually the outflow of risk happens through the materialization. This is not the case in this time, partially because of enormous government support in the past. But implicitly, the risks are now going away from the balance sheets of banks, simply because there is a huge nominal growth in income, so it somehow makes it better. Some of the risky loans were already repaid, so it decreased the loans, and also the value really increased enormously in recent years. So this is something that actually implicitly somehow makes the portfolio more sound. And these risks are receding, but still are elevated, and they are covered by the CCYB. Whereas the let's say stock of the loans, stock of the risk is still elevated. The inflow of new risk is considerably muted right now. Like the provision of new housing credit is below any historical averages, and this is partially because of those interest rates, and also this was confined by the binding limits. And there are two attenuating factors that actually make the black picture a little bit more cheerful. First, like the banks are still experiencing very nice profitability, which is record high right now, and those poor households were actually squeezed out from the property market. So right now there are only wealthy buyers on the market. So it makes like the portfolio more resilient, because of course wealthy buyers are more like they can withstand higher shocks. Okay, so this is more or less the macroprudential policy direction. You can see the CCYB rate as it was set in the last couple of years. Maybe two things to observe: that we are quite active, like we actually set it to 2% prior to the COVID. Then it was released to 0.5. In the hindsight view, actually, even some policymakers admit that this was a policy mistake, that maybe this was not necessary at the time. But shortly after the, let's say, most acute risk associated with COVID actually were over, then we again started with building the CCYB, and it reached 2.5%. But due to some outflow of risk, it's been changed to 0.25 effective as of this July. When it comes to BBM limits, they were reintroduced in December, but there is like 4 months period for banks to adapt. So effectively, they were in force from the April 2022. And now the bank board decided, due to very limited new risk, to actually deactivate DSTI. In their mind, DSTI is an indicator that actually is there, or it is a protection against unexpected increases in interest rates. So because interest rates are not expected to rise any further, so this has been deactivated, even again effective since as of this July. And if there is some time left. So let me also tell you something about our analytical tools that can be actually, let's say, broadly divided in two categories. Let's say first tools fall into a category of indicators that are calculated and are related to the property market. And the second is for assessing risk, and this is more or less stress testing tools or models or whatever you may call it. For actually assessing our valuation, we use two distinct measures. First, we call sort of macroprudential approach, and it is related to the safely attainable prices for liquidity constrained households. It means that, in our belief, is the market maker is the liquidity constraint, or the marginal buyer is the liquidity constrained household, and we calculate somehow what is the attainable price given the future macroprudential macroeconomic forecast or official forecast of the CMB, and we then actually compare it to the transaction prices. So it can be also understood as a sort of affordability approach. And the second is true valuation approach based on asset valuation theory, but it is adapted to the problem of small investor, because household is different from other investors. So, but like it's based on the discounted stream of future profits that is generated by the property. And because this is somehow related to the median income households, we also try to explore, let's say, tails of the distribution, and we calculate also accompanying indicators. So we calculate what is the percentage of households that can actually safely afford this average apartment. And now the percentage is well below 10%, so the prices right now are really not attainable for median households, only for those that are really well off. And the problem was with these overvaluation measures that they always, public and even policymakers sometimes tend to interpret it in a way that if the overvaluation is 30–40%, this is an indication how much the prices can fall in the near future, which was never our intention to convey such a message with these measures. So for these reasons, we also ventured for something what can be called house prices at risk indicator, which is essentially a conditional density estimation, but it's not based on quantile regressions, because now everyone just seems to run quantile regressions as crazy. So we are not really fans of this IMF approach, so we have come up with our own. And the indicator right now actually shows that the probability of disorderly price correction is very, very improbable. Like the probability was quite high a year ago, but now, no. And there are also like stress testing exercises, which thanks to the available data based on loan by loan or debt by debt approach, and they can be used for various analysis. What if macroprudential scenarios, but also for sensitivity analysis. And what these actually sensitivity checks show us is that actually the only big gun that actually can change the situation on the market is the increase in the unemployment rate. So of course, some may fear if the interest rates like suddenly increase by, let's say, 5 percentage points, then something like really terrible happens. No, like really only like unemployment rate has the power to change something dramatically. But this is, on the other hand, very unlikely, because the labor market in the Czech Republic is really still very tight, and so the labor force has been shrinking for some years. So there is like almost no room for a substantial increase in unemployment rate. We also perform another sensitivity check that is related to the increases in the energy prices and in inflation in general, and this also like has had really limited or contained impact on the increase of probability of defaults. So that's it. Thank you for your attention.
Thank you very much. And so now we have still like, let's say 17, 18 minutes for the discussion. So if there are any questions here in person, please just raise your hands. Yes.
Hi, thank you. Thank you very much for the very, very interesting presentations. So I have a first question for Miroslav. I was just wondering, you mentioned like very different like valuation models of overvaluation. So I was just wondering, for example, you presented a chart in which there is a big dispersion on the overvaluation depending on whether it's prudential or valuation approach. I was just wondering, if you could elaborate a little bit more about this discrepancy that just emerged in the last few quarters, and also whether you have produced a forecast. As you mentioned, it's not the same, as going forward. So any forecast, which will depend, of course, on the baseline conditions. But also, I was wondering, what would be the effect of the transmission lags between the tightening of macroprudential policy and then, the potential pressure on prices going forward. And then I had a question for Frauke also. I think you mentioned that you are not very concerned on financial stability risk and the baseline. So in fact, there was like, I think you mentioned like orderly correction, so that would be even good for financial stability. I was just wondering whether you may have some concerns about, even under baseline conditions, as some of the loans, may reprice, whether that could actually stretch, or there would be a tipping point in which some of the households would default, and what would be the impact on the banks. Thanks.
Do we have currently other questions? Yes, Rainer?
Rainer Martin, also National Bank of Slovakia. I have a question to both of you regarding the borrower-based measures. And I mean, you and also the speakers in the previous panel all seem to assume that the decline of the housing market will be relatively benign, nothing dramatic. But let's assume that maybe some of the adverse scenarios materialize and there is a much more drastic reduction of price valuations and the housing market comes to a more complete stop, so to say. Then the question to me arises, what are we going to do with the borrower-based measures? Because they were introduced in most countries relatively late in the cycle, right? So what is the right time then maybe to release them also? Is there a point to release them? And if you would say maybe that could be something, I know in the Czech Republic you did it and it was the wrong time, but maybe you can think about a time where it would be better suited, and if so, then what would be the pecking order, so to say? What do you think are those borrower-based measures that would be the first one maybe to scale back? Thank you.
Okay, so why is there a difference between macroprudential approach and valuation approach right now? They actually target different, let's say, market segments. Like the valuation approach is there for liquidity constrained household that actually buys new house or new apartment for their own living. And the valuation approach is there for those that actually plan to rent an apartment, and like really the motive there for buying is really renting. And the difference is that actually like the macroprudential approach is based on the idea that you can safely borrow and like what is the price that is safely attainable, and this is more related to the current conditions, because if the interest rates are high, then of course you are quite vulnerable for the 2, 3, 5 years to any shocks. So that's why for them it's more like overvalued, because like those first 5 years are really the key for repaying the debt. After that, the probability of default after first 5 years is considerably lower. So that's why the current conditions actually translate into this valuation more like heavily. Whereas the valuation approach is more based on the long-term renting. and means that it's not that much dependent on the current conditions, but the, let's say, steady state or long-run conditions weight more in the valuation. So, because right now there is the interest rates are extremely high in historical perspective. That's why there is a difference, if it's made clear. And the second question, the transmission of macroprudential policy and how actually it may impact future property price growth. Well, that's something that actually the bank board asked recently, so it's definitely a relevant question. My answer would be that actually right at this moment, the release of BBM measures would have only very limited impact both on the provision of new credit, and that's why it would also have a limited impact on prices. We actually did some calculations, and our conclusion is that even if those BBM measures were deactivated, the current provision would only increase by, let's say, 10–15%, and it would be still below historical averages. Of course, this is it really depends on the current monetary policy setting, but we do not expect, and this is also the communication of the bank board, we do not expect the monetary policy rates to decrease in near future. So right now, I think the impact would be rather limited.
Indeed, and then, on top of that, we do observe across the countries currently regarding the borrower-based measures in increase in the DSDI, which is logical because the interest payment increases with increasing interest rates. But at the same time, I'm not sure whether you want to loosen the measures in a situation if there was an adverse scenario. Do you want to give an additional incentive to people to buy houses? It's not really fostering financial stability. In other aspects, of course, it can be beneficial. On Laura's question, of course, it is already somewhere in the data, this repricing of loans, I would say, because what you see is, the new loans are for buying new houses, but it's also for renewing your loan when you're coming at maturity. So that's probably why we see this strong drop in new loans. And even this strong drop is not something that looks extremely concerning currently. So we are monitoring it. We are monitoring this data. The individual countries are also looking into NPLs in the housing sector, into stage 2 loans and stuff like that. That's very important to look at it. But at the current situation, the data we have don't suggest that there is an adverse scenario. But I wouldn't exclude it. It can happen. We were, let's say, a year ago, we wouldn't have expected that we are where we are now. No? Yeah.
We have another question.
Maybe if I can also answer the question when to release the BBM measures once there is a serious hit. I think there is no general agreement how these BBM measures should be actually used or applied. Some actually target or use them just for cooling the market, both mortgage market and the RRE market. But in our view, eventually, it only limits the new inflow. If the risk already accumulated, there is no room for BBMs to change anything. So in our view, actually, these BBM are only there for limiting the build-up of systemic risk. So if you somehow assume that actually even some mild increase in, or let's say that the credit dynamics will pick up in the future, and even if this doesn't pose any additional systemic risk, so they can be deactivated. Once you actually feel that there is a huge danger that actually the inflow of new risk may contribute to financial stability risk or systemic risk, then maybe it's the time to activate them.
I I will try to a little bit replace the spirit of the work of Alexandra, who fell sick. And she wrote a fascinating microdatabase chapter for our last financial stability report in Austria. And actually, we try to enrich our analysis by going beyond the traditional vulnerability indicators and integrate the holding of wealth and really, so income deciles, HFCS-based data, that's what she wanted to present. And it turns out that in Austria, mortgage loans is something of the wealthy, which is good for financial stability, because they, even in the situation we're all in, they have buffers, they have different buffers. And it's also something, I mean, you don't buy your flat or your, they have added flats during the pandemic, but really not out of the current income, but from what they either inherit or they have accumulated. Is this an approach you, so we think that this microdata-based approach holds really the future of assessing financial stability in the future, and is this a way you also, an approach you also follow?
Yeah, thank you. Tomáš Lečík, I'm a local from the Austrian Central Bank, but I'm Czech by passport. I have a question for this panel or any other expert in the audience, in fact. How useful is this concept of equilibrium real estate prices in general? Are you aware of any evaluation with hindsight exposed how this indicator performs relative to actual prices? Because I'm aware, you said yourself that if there was a spot on the earth where one should be worried about real estate development, then it was the Czech Republic, one of the places. At the same time, you are not expecting any major adjustment, right, in the real estate price. I spent some time in Luxembourg, for instance. Luxembourg is a very special case. Everyone has been talking about a bubble for 30 years now, a bubble that needs to burst there, real estate bubble, and nobody has seen it yet. So is it something useful for you, or is it something more like the equilibrium exchange rate, for instance, where there are so many concepts, how to measure it, and nobody, in particular not the market, really cares about it? Thank you.
Thank you. I'm Sophie Wartl, Vienna University of Economics and Business. I have another question regarding financial stability. What is super important about this topic are the sentiments and also tracking sentiments. So what do actually the agents that are active on this market, like homeowners or potential future homeowners, what do they actually think, believe, and expect for the future? That would also be very important to predict the future. Also to see whether many people have actually changed their plans because of the developments we have seen. Is this happening? If so, then we should expect completely different developments in the next years. Or do people not change or just postpone? So when it comes to that, I would be very interested if any of these countries is actually tracking that, and if not, why not maybe also. Thank you very much.
Thank you. So I think for the sake of time, we stop here with the questions and just ask you, I think, ladies first, and then we can close.
Maybe I give it a start and Miroslav will compliment me. Very interesting questions indeed. On the work of Alexandra, I was very much looking forward to hear her work, so it's really a pity she couldn't join. We pre-discussed it a bit, and we also discussed it with Jan, who was aware that there's some work at the ECB going on, I think, on a similar topic. So I'm definitely putting on my list of homework to read that paper. It is a very interesting approach. We did observe also this fact that it's more the wealthy holding mortgage loans in particular, which in a way is reassuring from a financial stability perspective. And it's also one of the reasons why during the COVID pandemic, we didn't see a strong crisis or prices dropping during the COVID pandemic, because it was more the wealthy people who tended to be less affected by the COVID crisis, who held the property and didn't need to sell it. So yes, indeed, it's a very interesting thing, and
I will definitely read what she did and also what the colleagues did with lots of interest, because I think there's a new vintage of this thing now. On the second question, I was actually, during the whole talks before, also thinking about this concept of equilibrium, valuation of properties and so on. Very often we are using price to income deviation from average, or the measures which Miroslav has presented. There are very few models which are taking supply factors into account. That's precisely what you need for these situations like Luxembourg, for example. It's a very, very typical example for that. We do have a model at the ECB which is also taking into account supply of housing, which then has a very strong effect. Depends what you want to look at. If you want to look at affordability, it doesn't matter, because what matters is where the price stands compared to your income. If you want to look at the equilibrium, you somehow need to take into account that in Luxembourg there's not an unlimited place for constructing new houses. Plus, you have all the supply constraints we currently observe, which have a strong impact. So we try to look at both, but the data are scarcer on the other side. So we are currently working on that. And just on the third point, yes, it links a bit back to the first point on the surveys, I would say. We look into sentiment more on an aggregate level. I didn't show you the chart because I thought I would have less time. On the EC surveys, because in the EC surveys we have by countries, maybe not all countries, but a number of countries, the intention to buy a house and to improve a house. And that shows a bit what consumers expect, I think, going forward 3 or 6 months. So it's not on a micro perspective. Micro perspective would more be using the data from, let's call it the data from Alexandra. Thank you. I don't know whether you want to add something.
I would definitely jump on the bandwagon of those that actually prefer, let's say, micro approach to assessing the risk. Of course, this is conditional on good data sets. And we actually do collect a lot of information about individual loans, but also about the clients that actually ask for those loans. So we have a lot of information that can be used for really assessing the risk and for modeling, and this is our current approach as well. So I would really support this, like to go micro if possible, but of course this is dependent on the data availability, but this is something to be supported, definitely. When it comes to equilibrium price, the problem is that really there are a lot of definitions, and for me they are not kind of useful. Like the problem is that once you define something like equilibrium, you just run some econometrics, and you, by the use of econometrics, you come up with some estimate of, let's say, equilibrium price. Not really a fan of this approach. That's why we actually adopted our measures that are more or less like, let's say, to be a little bit pompous, it's a structural model where you do not need any like past data. The only thing that actually you care for is about the future. What are the future prospects? Because when you would like to calculate the expected stream of profits, it doesn't really matter what happened in the past. It only matters what actually will happen in the future, and that's why we also adopted this prudential approach, because it has some meaning. Like it has, maybe you can argue that like an attainable price can be defined by like that, but once you actually agree on the definition of attainable price, then you can exactly measure it. I would compare it to the, let's say, speed limits on the highway. We can argue whether, I don't know, 130 is the correct, like, correct speed that should be actually set on the highway, or whether it's 110 or something. But once you actually decide that this is the prudential, let's say, limit, then you can tell exactly how much you are speeding. If I'm and the supply side issues, not really fan of, like they can explain prices, but do they actually tell you something about equilibrium? Just imaginary conversation between two guys, and someone says, "Oh, I can't afford to buy the house because the prices are just like too high for me," and the second just says, "Oh, forget about it. It's like it's all about demographics. Demographics like explains that all, so you can buy it because it's explained by demographics." So this is not very useful. It's really about like financial stability risk, and you should come up with some definition that is somehow related to the financial stability. An attainable price that can be safely like attained by debt financing is something that is palpable, something that you can touch upon. And the very last question about sentiment. Yes, sentiment is very difficult to predict, but for me, at least in the Czech Republic, this is really something short-lived usually, and in the long run, there is a really strong preference for all housing. So after some while, everyone wants to to buy his own house. The only thing why there are some people postpone is because they cannot afford it right at the very moment. But once they actually can attain or can apply for the mortgage debt, they immediately do it and immediately go for their own housing. But maybe the very last thing, that actually based on our measures of evaluation, there are some measures related or derived from these measures that can be somehow used to measure the sentiment on the market.
Thank you very much. Just please let me allow one last thought on microdata, because I think that's the future of the macro-pro analysis. And here I just would like to cite our former deputy governor, who liked to say that when you have macro data, you can use macroprudential measures as a hammer. When you have microdata, you can use macroprudential measures as a screwdriver, just to fine-tune and to find really where the risk is. So I think that really microdata is something that we should look for. So thank you very much. By this, I would like to close this session, and I think now we are turning straight to the last one. Thank you very much.
Yeah, welcome to our third and final session of this really instructive afternoon. So we've talked about price developments and financial stability, and the gist of what we've heard is, well, there is a price correction, but nobody seems really to be very worried that this is going to be a disorderly correction. Nobody is all too worried about financial stability risk. And now we're talking about housing affordability, and perhaps the fact that nobody is afraid of a major price correction is not such good news for affordability, but let's look into that. So I have three very distinguished speakers with different aspects of the issue at hand. We've heard that microdata is the way to go, and Karin Wagner, who is a senior principal here at the National Bank of Austria, has come with some interesting insights from microdata. So I'm looking forward to seeing that. We have another aspect, which is Latvia, a small Baltic country, and Andrei Semyonov, who is also working at the central bank there in Riga, will give us some insights into the situation there. And finally, Jaime Luque, to my left, who is a professor at ESCB, business school in ESCB, sorry, in Madrid, as a professor of real estate. He'll come with a specific policy, rent control in Catalonia or in Barcelona. So we'll have data, we'll have a specific country example, and we'll have policies. And I think that will give us a lot of material to think about how to address housing affordability. Karin, do you want to start and showing us your data?
Okay, thanks. So Thanks a lot. This is work together with my colleague Christian Beer. He's also present here, not in person, but at WebEx. So, Christian, if I say something which is completely wrong, you will correct me. What was the idea? First of all, no? Yeah. First of all, this is really work in progress, as we microdata are important, but the fourth wave of HFCS in Austria was published 2 weeks ago. Therefore, we had 2 weeks time, more or less, to do the first insights, although it's produced inside our bank, but time was short. We started with this to look at housing costs, and this is one of the indicators when talking about affordability. We started this in 2010. The HFCS is, it's a bit not a panel data anyhow. We have now data for 4 waves from the HFCS. So we see, and I will present it in a second, this is really a stable picture which we can see here. With the fourth wave, we had a problem. COVID was in between. So when we started 2010, then 2014, 2017, and then it was planned in 2020. Well, everybody here knows, then came COVID. And as there was we had the field work, and these are in-person interviews. So there were lockdowns, and it was not possible to contact them so easy. So with households at the end of the distribution, which were in normal times not easy to reach, because the richer persons do not like to answer. With COVID, they were even more restrictive with the answer. And this was really, especially with the high-income households, has an impact on our results. To give you an example, the maximum net wealth, the value, was in the third wave 42 billion. With the fourth wave, we have the corresponding, there are 12 billion. So with these really high income people, we have a problem. With the minimum value, it's with 60,000 euros. This was between the third and the fourth wave the same. But with the high income, there were really more scarcity to respond. What is special in Austria? We have a housing market with a comparatively low ownership rate. We have, I always say, more half-half, so around 50%. And compared to 2010, from 50%, it went down to 47.9%, and the rental rate goes slightly up. Because of historic reason, Vienna was bombed in the First and Second World War. So we have there was place to erect these social houses. We had a really big difference between the provinces. And what is special also in Austria, we have 2/3 of these 50% rental market, it's subsidized in somehow. So there is a law behind how much it is allowed to higher the rent. So for our housing expenditure, we define it. There are 3 or more approaches how to measure affordability. One is the housing expenditure. We take the so-called expenditure approach, where we define it as the housing-related expenditures in % of the net household income. This approach is well used also with other literature because of its simplicity and low computational effort. Another approach is the residential income approach. This requires more or less agreed budgetary power reference budgets and or poverty indicators, and this is with this agreed is a problem. And what is also discussed is the user cost approach, but this depends on the prices, on the house prices, on the credit availability, on the tax treatment of the country, on the role which plays ownership as protection or insurance against rent price risk. So, and this user cost goes more or less on the investment approach, and this is what we don't want to tackle this on with housing costs. So we decided to do this expenditure approach. And here are the results. What we see more or less, there is the second to the fourth wave. We see that the owners without loans, they have the lowest expenditures, so about 13%. What we also see is, and it's on the lower end, that with the rents around the quartile, the tenants, the lowest quartile, the first quartile has more than 50% spending on housing expenditure. This is only the rent and the energy costs. There is no consumption inside. There's just the rent and the housing costs, and we decided to include the rent because sitting in a cold flat is not so nice. Anyhow, there we see this is the problem. The other result where we see here the tenants with 37% and a bit lower expenditure for the subsidized tenants, at least 2 percentage points lower. This is what I said, at least in Vienna, we have only 19% ownership rate, all the other is rents. So this helps. What we also did is that we saw, okay, compared the spread between the owners, which is here in red, and compared to those distribution of the renters for the tenants, this grows at the higher end of the distribution. In the middle, you see the comparison of owners and tenants there, and the dotted line is always the third wave. And the solid line is the fourth wave. There we see with the owners, so with the red one, that compared to the third wave, there have now a bit lower expenditures. This is because between 2017 and 2021 there was this low interest rate environment, this lowered also the loan amounts. and at least a comparison between owners with and without loans. There you also see, the solid line is the current, those for the fourth wave, that the higher end there, the current is a bit lower. More or less what we see here, that more than 78%, it's here, more than 78% have housing costs which are lower than 50%. Yeah, here 78, here we see there is the 50% line. So this is the one message. To sum it up, we say it's relatively stable. We have to look at the tenants in the first income quartile, because 50% of the income is enough, so that this doesn't go up. So what is the challenge for affordability reasons? Okay, that we keep this subsidized sector and not, as other countries, that we give it to the private sector. So, the owners without loans have the lowest expenditure. This was the first insight in this microdata. What we aim is to have a comparison to Germany. Why Germany? Because the housing markets between Germany and Austria are more or less, at least there are similar structures, and with one of the CESEE countries, or two of the CESEE countries. And what we want to do is, as we had this field work ending with between May 2021 ending with February 2002, and afterwards inflation went up quite strong. So, and this was the idea from the IMF paper, where they you aged the data there, so to expand them by the COICOP HFCS groups, housing and housing related, so group 4 and 5, and then so to have also information what changed concerning the expenditure with these high inflation months. Thanks a lot.
Karin, thanks a lot for these very interesting insights, and I think it gives us a lot of food of thought, but a lot of food for thought for the two other countries we're going to look at. Also because, well, these are countries with very high ownership rates, right? And so one question that we can discuss later that comes from your presentation is, isn't it much better to own if indeed the share of income you spend is so much lower? But I have one question, if I may. When I look at this, because I was thinking, when I looked at your data, 50% of income in the, I think it was the lowest quartile of renters, is spent on housing, right? And I found that absolutely shocking, but perhaps because I'm thinking wrongly about this, because I do remember, so I was just looking up this overburden rate, which you show at the end, which, if I do remember correctly, is if you have spent 40% of your income, but that's net of housing allowances, I think, then you're considered overburdened. So I'm surprised that given these data there, then in the end you have such low overburden rates for low income households.
We have there a message that this owning without loans is the best way. Yeah, this is one of the message, but you have to afford. So you have to buy first of all. So to come to the possibility, yeah. There we see the problem. Yeah? So the message, if you then own, then your housing expenditure is low. So at least in Vienna, it's the most prominent, but this is also for all in Austria. we have this possibility, and it's not a social stigma if you cannot afford and if you have to rent. Yeah. So this is,
there's a question about asset distribution. But
this is my answer. Yeah.
To the one, but
and the other what we discussed before, that the really overburdened and the really vulnerable households, we have with HFCS data saw that the high loans are also with high incomes correlated. Therefore, we don't. 2/3 have no loan at all in Austria. HFCS says. So microdata say, okay, we have really a comparable low debt situation.
Okay.
High loans with a high income. Yeah.
Perfect, and we're going to look into that more, but Andres, I'm going to ask you to present a little bit the situation in Latvia. Low rental rates there.
Yes, hello. First of all, I would like to thank the organizers for a really amazing conference, very interesting panels. It's an honor to continue with a brief overview of what is happening in Latvia. I will cover briefly on the recent trends in the demand, activity, supply, prices, and particularly affordability. I'll touch upon also some structural issues that hopefully will set fruitful ground for a discussion later on. So beginning just as a brief overview, chart on the left-hand side is the total transaction number from the State Land Register. We see that since the second half of 2022, there has been a quite correction in the activity in the housing market. The drop has been quite sharp, particularly sharp in the region near the capital, but this is partly reflected also, partly reflects also the fact that during the pandemic, due to this remote work possibilities, there was a quite an increase. So it's a correction from that. The chart on the middle, and I really want to emphasize this one, is the supply of new building area commissioned each year per inhabitant in square meters. And we see there that Latvia, and I use the other Baltic countries as closest peers, has been lagging behind our neighbors and also lagging behind our national development goals. So this is really is an issue. I will touch upon that later as well. What we see from the listing data, this is from private company listing data, is that due to the energy costs increasing and hence the heating bills increasing, there has been an increase in supply, and this is the chart on the right-hand side, of the standard series Soviet-era apartments, which still form the majority of the transactions in the capital, and unfortunately are on average quite energy inefficient. But supply of those apartments, existing apartments, has increased and it seems to be quite elevated still. What does it mean? So first of all, due to the drop in the activity, we see that, as already mentioned in many of the region countries, we see that the price growth is moderating from the highs of 16% to the very recent reading of 6% overall. But I must emphasize that the trends are particularly different among different housing segments. And here I want to emphasize the big difference between existing standard series apartments and the new apartments, new housing. Due to this increased supply and energy costs increasing, the prices of standard series apartments actually has already, price growth has already reached negative. The prices are declining and it has been so since the second half of last year. On the other hand, the prices of new housing, and it's already been reflected in the charts due to the construction costs reaching double-digit levels, are set to increase and are increasing by a magnitude of 19–18% year on year. So quite a different trends, and this of course has some implications both due to housing affordability and decarbonization. Talking about, just a second, seems to. Talking about first about the housing affordability, looking at the average, so to say, average temperature in the hospital, it seems to be okay. The chart on the left-hand side, namely the price-to-income ratio, is at historically high, good levels, because the wages have been on average increasing quite swiftly as well. They haven't lagged that considerably, the housing prices. But looking particularly at the new housing segment, and I should probably explain a little bit more the chart on the right-hand side, and also taking into account the increase in the interest rates, the picture is completely different. So chart on the right-hand side shows what should be the income of a household in order to be able to buy a new housing, new apartment or house, so that the mortgage payment does not exceed, total debt payment does not exceed 40% of the income. And to put things into perspective, the average net wage in Latvia in the first quarter of this year was around 1,000 euros. So in order to basically to buy an apartment that is 70 square meters or three-room apartment, one needs to have 2.5 the amount of the average net wage. So definitely this will imply that the activity is somewhat set to decrease in this segment, and we can see that the affordability in this segment is really deteriorating quite sharply. Another issue I would like to touch upon is that unfortunately the activity in the new housing segment has been weak already before, has been weak already for almost 10 years. Here's house price index weight picture, namely it reflects what share of the total turnover in the housing market is attributable to newly built housing, and it has been rather low for Latvia for 10 years, while in the neighbor countries it has been increased. And here, talking our session, in terms of our session about the affordability, I would like to make a claim that the purchasing power is not the single culprit and maybe not the main culprit. And I have two hypotheses to test, namely one thing is maybe the size of the middle class is smaller or shrinking in Latvia compared to other neighboring countries. Or maybe the purchasing power of the average household is lower compared to neighboring countries. The chart on the left-hand side shows the proportion of income earned by the 6th to 9th decile of households, and we see that actually it does not differ that much among Baltic states. If anything, then Latvia it is slightly higher. What we see on the right-hand side chart is that on average the purchasing power of a household in Latvia is indeed lower than in the neighboring countries. But here I must mention, and I apologize, I don't have any good time series on the price data, but price to income ratio in Latvia is somewhat better actually. So it's not the story about the average purchasing power being considerably worse in Latvia. So I would like to argue that there are other issues, and one of the issues is this very weak supply of new housing. and also the fact that the prices of new houses are 2 to 3 times per square meter higher than for the existing housing. So unfortunately, due to the recent trends, it seems that there might be some sort of also bad equilibrium, risks of bad equilibrium. Namely, what I mean by that is that maybe due to the rising interest rates, a household will not be able to obtain a mortgage and buy a new energy-efficient apartment, but instead will buy a Soviet-era standard series energy and efficient apartment. But instead of paying higher mortgage payment, the household will actually pay higher heating bills. And this is something we definitely need to think about and address. So this concludes my presentation. I'm very happy to discuss it later on.
Yes. Thank you very much, Andres. And when I look at so there are many questions that came up in my mind, but we are going to go into those later. There's just one thing I cannot get my head around when I think about countries like Austria or Germany, where there are many households that rent, and then other countries like Spain and Latvia, where everybody seems to own an apartment, but then you have these indicators that show that the average household cannot actually buy, so the average income household cannot actually buy a decent apartment. So I just wonder how people do it, that everybody, well, of course, one reason why why there are so few renters is that there's no rental market, really, there's no supply, right? But still, you wonder how people come by and actually get hold of an apartment, but maybe we can talk about that later. Jaime might have insights as well. So Jaime is going to talk about rent control and some issues, perhaps some other issues of the Spanish or one regional Spanish housing market. So looking forward to that.
Well, hello everybody, and again, also for me, it's a pleasure to be here, and thank you to the organizers for inviting me to present. The reason I thought that the topic of rent control would be interesting for this audience, that I understand that it's specific to the Central and Eastern European markets, is that public policy right now, it's probably the most debated at the regional level. It affects everyone, and in particular those that are more on the low-income side of the population. So what I wanted to do is to bring some evidence of what we know now, and what we know now about the policy of rent control. It's a particular possibly interesting in countries such as Austria and Germany, where there is a significant part of the population that rent. And also we know already that this policy has been already adopted in many countries. It seems that we are going through a third wave of rent control. In Berlin, it's a very well-known case. Probably all of you are aware of that. In year 2015, it was adopted for 294 municipalities. Also in France, very recently, in year 2022, they have adopted a nationwide cap on rents. In Spain has been recently adopted in April 2023, rent control for the whole country. Previously, and this is what I'm going to show you, in September 2020, it was adopted only for the autonomous region of Catalonia. And also in the United States, it was in year 2022 when it has been extended. And in New York, California, it had a lot of debate to 2019. So it seems that it's going everywhere. And again, the reason is that there is a lot of housing unaffordability, and politicians, of course, care about that, and they see very high prices, and the first thing they may think is, let's regulate prices. And also the reason I think it's also interesting is that there are not so many studies on rent control. We know that very specific, for instance, for the case of Berlin, there is a very nice paper that provides kind of very negative view on rent control, negative aspects. So what we know it's about at the city level, at Berlin, San Francisco, Minneapolis, that's the famous papers that we know about. And the case of Catalonia is really interesting because it has been adopted for every single property in 60 municipalities in Catalonia. So those that are regulated are in the treatment group, those that are unregulated are in the control group. We have massive amounts of observation, so it's not just one city, it's a bunch of municipalities. And I think what the results we get here are pretty interesting. So if I have time, I may come back to this or maybe during the discussion, but there are different types of housing policy. And one is just going directly and regulate prices. Another one is subsidizing the supply, which is giving a subsidy or grants to developers. Another policy would be to help the households, giving them money, the vouchers, or the zoning, which is on the quantity constraints. I'm going to talk about rent control. As you can see, there are a bunch of papers already, but again, because there is a third wave of rent control, I thought, again, it might be interesting. So policy was implemented in September 2020, year 2020. And again, it applied to every single property for those municipalities that were called TENS. And if the property has been with a contract for the last 5 years, it cannot go higher, the rent. It's another restriction. And I'm going to go directly to the results because I've been told to keep it very short. So, so first graph, you see rents. So rents, it seems that in the first half year, they go down, and it seems that it's effective for the first half year. They go down by 5% with respect to the control group. But then after 1 year, it becomes ineffective. So the goal of the policy is to reduce rents, and we are showing that it's ineffective. And I'm going to tell you a little bit later why we think it's happening, given the piece of evidence I'm bringing now. Then also what we see is the volume of rental supply goes down by about 18%. That is, there is about, say, 20% less rental properties on the market because of rent control. At the same time, the volume of sales, property sales, increases by 38%, which is a huge number in economics. And then property prices go down in regulated areas by about 3%. So intuition behind that is that you impose rent control, owners of those properties basically don't get the realized returns. They massively take out those properties from the market, which explains the decrease of 18% in the supply of rental housing, and then they sell their properties. Which explains the increase of sales volume of 38%. Once you sell a lot, you bring down prices, and this is about 3%. So this is kind of in line, but in a very robust way, because we have a lot of municipalities here. It's in line of what we kind of knew from a paper of rent control in Berlin. There are some exceptions that is like here is the law, it's specific to all properties. And here the question is it really helping? We understand that we are distorting the market, but are we really helping the vulnerable population, the working class? And then what we did was we calculated by how much house prices, the value of properties went down in Catalonia. And we calculated they went down by 1 billion euros. Because of rent control. It's causality effect. And that's the value of the properties for the working class, up to the 75th percentile. So if you look at the value of the properties for the top class, which is the top 25 percentile, the richest, the value of their properties increased by 1.1 billion. So basically what you are increasing, what you are doing is increasing inequality by more than 2 billion euros. And I'm talking about a specific region in Spain. And this is the consequence of rent control. So it's increasing significantly, increasing significantly the inequality, is bringing down the value of properties by 1 billion of those that are in the working class. And keep in mind that this is the main asset for savings. We are not talking about the rich people. We are talking about the working class that they save in housing. And then the question is how much the tenants would benefit. Okay, there would be people that are losing money, but maybe we are helping other parts of the population. So we calculated on an annual basis, tenants in the working class, they get a benefit of 8 million euros. So we may think, well, if we keep this policy for 10 years, it's 68 million euros. So compare 68 million euros with a drop of 1 billion euros in property value. So there could be a different mechanism that could be subsidizing those working class tenants directly through vouchers, or even better, would be to subsidize the supply of housing, developers, grants. And this brings me to the first slide that I wanted to show you. And I'm not going to continue, but we can discuss later, that after I've been studying this for many years, and what seems more right in terms of market efficiency is to give the money to the developers, because they're going to basically bring down the returns. It's going to make building affordable housing more effective for them. And there are some instruments that have been applied in the United States that we may want to have a look in Europe, that we don't have them. And I'm going to skip all these slides, but I'm going to refer to my book where what we do is to look at the fiscal policy, fiscal housing policy in the United States, the fiscal instruments that has been used, in particular the tax increment financing and the low-income housing tax credits, that are massively improving the housing market because they are increasing the supply of housing, and they work through the market, so they decrease market distortions. I don't want to keep it very long, so I'm going to stop here.
Thank you, Jaime. That's very fascinating. And I do have one question, because I was really so why was the value of the property of higher income owners not affected as much? How come?
That's a great question, and we are trying to rationalize that. It seems that probably the ones that are more scarce are those housing, or the ones that need less the money are the owners of the high-income housing, so they are not incentivized to sell after rent control. But it's something at this point we don't know. We see like we are making the richer much richer and the poorer much poorer.
Too bad. And I've been thinking about Latvia, Andres, because we discussed it before. So Latvia doesn't really have much of a rental market, and you also said in your talk that it's very difficult. So the supply of new housing is very scarce. Most people still live in the old serial Soviet-style housing, but the government has tried to build a rental market, right? And you said it's not really coming along. So do you think some of these instruments that Jaime has been mentioning, so either demand subsidies or subsidies for supply, are lacking in the toolbox of the government, or what is your assessment there?
Yes, thank you. Well, recently there has been government-supported program aimed directly at building rental houses in the regions, and so far, it seems that the activity there has been very, very sluggish, and the program has not kicked off as expected. And one of the main reasons, at least according to the developers and the market intelligence, is that, well, actually the ceiling set, because one has to set the ceiling, the purchasing power in the regions is considerably lower. For instance, in some Latvian regions, it's 20–30% lower than in the capital. And one has to set the ceiling for the rent price that a developer can ask. But unfortunately, the construction costs do not differ by region. So it's a very tough situation. Probably the government support could be increased, but then again, it's a drag on the budget as well, and it should be carefully weighted. Regarding your first question on the activity in the new housing market, I showed actually the weights, and these are actually transaction weights. And given the fact that the prices of new apartments are 2–3 times more expensive than the existing ones, then if one looks at the transaction numbers, then it's like 10% of the all transaction in a given year. It's in the new housing, and therefore I think it definitely indicates that it's also that especially given that the interest rates are increasing, it's also the fact that not everyone can afford, and we definitely need to think about to balance those issues, for many issues, the budget, the affordability, especially in the region, and also we need to talk about the issues that harm the housing supply apart from the discussed issue.
Rent control.
Yeah.
So I have many more questions, but we're running so scarce resources, we're running out of time. So I do want to give you the chance in the audience, online or here in person, to ask your questions. And if you don't have any, I will have more. No? You're stunned? Okay, here from the nature and resource. No, you have to say your university again.
University of Natural Resources and Life Science. Really complicated. I'm sorry for that. I've got a question for Jaime. So you're in Vienna, so there's a big tradition of subsidized limited profit housing. Could you sketch for me, as I have not read your book, what's the difference to tax cuts you seem to be proposing as it is done in the US? Could you sketch for me where the big difference is, why we should go in this direction, your opinion, and not continue with what has been done in Vienna for a very long time?
Right, and that's a great question, because also related to the first intervention today, I learned that 2/3 of the rental housing in Austria is subsidized. So we call that vouchers. And it seems, again, it's a well-intentioned policy. You want to help those that don't have the money or are struggling with housing. But the problem is that, in short, in a nutshell, the market is capturing the surplus. The market understands there is more money and rents go up. A great example on that, it's the Help to Buy program in United Kingdom, which, it's the same intuition that the government is giving money to the person who is going to buy housing, in this case with a mortgage. And a study by the London School of Economics, they show that house prices go up, and the effect is actually against property owners.
Maybe I did not explain well, or I misunderstood you, but vouchers would be you give the money to those who rent, while here it's subsidizing actually the developers.
Okay, yeah, I was thinking you wanted me to compare. So if you give vouchers that you're bringing up prices, and in most of the cases, what we know is that it's somehow inefficient. If you give the money or the grants to the developers, basically what you are going to do is you are going to work through the capital structure of the developers. So instead of needing so much equity, you are going to reduce their equity or funding needs. that's going to increase the returns, and they are going to step in and they are going to develop affordable housing given a rule. So there is going to be some criteria that they have to meet, say 30% of their building or the apartment is going to be affordable in the sense that they don't charge more than 30% of the tenant's income. And at the end, because you are giving the money through, to the developers in terms of reducing the needs in the capital structure, they are going to step in and they're going to produce something which is a new asset, which is the building itself, and then you're going to increase supply. So there are two ways to do that. One is called the tax increment financing, which is a beautiful tool in the sense that what you do is you're going to compute the tax increment of having a new building in that plot of land. Because property taxes are going to increase because now we have that building. That tax increment is going to generate cash for the next 30 years. You're going to discount them to the present. That's the money that you're going to inject to the developer, and it's going to be like free money. So suddenly the developers understands that they're going to make a profit and they're going to go and develop there, and suddenly you have more housing under certain conditions, which is affordable for at least some of the units. And the second one is the LIHTC, low-income housing tax credits, which is the big corporations like Verizon or Chase Bank, like the big ones in the States that are buying these tax credits. So basically they're paying less taxes if they give a capital injection to the developers to produce affordable housing. So you are working through the supply side, and you are producing assets that you didn't have before. And that's why it's, in my view, it's a much more efficient way.
Yes, I think we have, actually, I think the policies here in Austria is different still, but you should study those. They are great. We envy them. Cooperative housing, etc. But yeah, those are interesting comparisons. But we had more questions. There was one in the back, and then it will be to you.
First, Jaime, I would be interested if you could explain or confirm that actually rent control is a good policy measure to increase home ownership rates. So if this reduces prices, actually, could this be a policy if you want to increase home ownership rates? And for Karin, maybe a quick one also. I mean, we heard a lot today that affordability for owners or new owners is decreasing. What are your predictions for the next HFCS wave? Will this also affect the rental sector, or how this will come up in the data? Thank you.
Yeah, Jaime, you can start, and sorry, and then we'll take Laura's question.
Yep. Rent control, what it does, what we show, it's not bringing down rents. But it's bringing down the value of properties. But the point is that this is the savings of the working class. Most of their savings is the house itself, so you are going to make them much poorer. I wouldn't choose that path to make prices cheaper so that then people buy, because you are like it's a wealth transfer in some way through the vulnerable population. I would work more through the mortgage market, like Freddie and Fannie in the States, that you are basically somehow focusing on the working class to provide them more cheaper mortgages.
You're a fan, I take it you're a fan of US housing policies.
That's what I know.
Karin.
Yeah, we see what I said, this Statistics Austria data, that the ownership, while 10 years decreases by 2 percentage points, so it's quite stable. Anyhow, we see the same phenomenon also in the HFCS. So we looked on it. We are now doing the field work for the 5th wave. There we see it also with the HFCS that the ownership is decreasing. Yeah. So microdata support the macro data.
Actually, Karin, I mean, it's a bit of a stupid technical question, but I was a bit puzzled when I looked at your data, Because I think your renters rates and your ownership rates didn't add up to 100, and I was puzzled and thinking, what is the 10 percentage points that are missing? Yeah.
The missing are those free flats for example, for Unido or something. So for people just for working here. Yeah. So
that's 10%.
Yeah, it's about 10%. Then you have a mixed also, where a part-time is owned and the other one is rented. So therefore it doesn't end up to 100%. But we see the same phenomenon with the microdata.
Laura, you had some more questions.
Thank you. Thank you very much for the very nice presentations. So I have a couple of questions. One is for Andrzej. So you mentioned it was quite striking, yeah? So the difference, so you mentioned first that the activity in new building housing market is sluggish, but also you show this differential pattern between existing and new homes. I was just wondering whether maybe you could elaborate a bit more, of what is driving that, for the new housing. I mean, is it more related to the price of land because of zoning restrictions or supply constraints and so forth? Or is it mainly maybe like demand side because maybe households are more sensitive to the energy efficiency of new buildings, so they are just increasing the demand for that? And then to the extent that is maybe related to the supply side, and whether it could be like the cost of materials or the cost of funding, so whether there is any role at all for green mortgages to avoid this bad equilibrium you mentioned, or to adjust some macroprudential limits so as to enhance affordability, for new energy efficiency construction. So, and then I had a question for Jaime, if I may. So I guess that, so I'm not very familiar with the situation in Catalonia, but of course rent controls is being discussed widely. So I thought that sometimes, they are also implemented to fight off speculation. So I was just wondering, if that is the case, what will be the share, let's say, of buy-to-let investors relative to owner-occupiers, also, I guess it's part of a package, if we want to deter speculation in the real estate market, so you also have like all types of taxes, like transaction turnover, transaction costs as well as capital gains, and sometimes you can also like make them contingent on the holding period. Anyway, so you want to explain a bit more of that? Thank you.
Andres, you can start, and then we'll have Jaime.
Thank you for an excellent question. The determinants why the activity in the new apartment segment is considerably lower than the existing one concerns both, actually. It's quite complicated, broad issue, concerns both demand factors. For instance, also mentioned by market observers, developers, one of the facts is that due to the last financial crisis, the bubble was much larger and one of the largest in EU countries, and therefore the burst was one of the most painful in Latvia, and there seems to be some stigma among the households for taking a large mortgage, because they still have in the memory. Some part of households still have in the memory the recent experience. Also, in terms of purchasing power, I made an argument that maybe it's not the whole story, but there's a twist into that the largest developers, they actually operate in all three Baltic countries, also on top of that Germany, Scandinavia, and just judging from that perspective, it's more profitable for them to enter these markets because you can sell at larger prices in those markets. So there might be also this issue as well. In terms of supply, one would definitely need to mention that the shadow economy is rather high, and it implies both that it hampers competition in the construction sector, but also it implies that a considerable part of households are not able actually to obtain a mortgage because one cannot get a mortgage with gray area income. So it's definitely a problem. Regarding this bad equilibrium and the possibility to review BBMs, perhaps for new mortgages to set it at a little bit higher. We are actually considering this. It's at a very early stage yet, but we are considering this option because it's really an unfortunate equilibrium, just also using household consumption and finance data and CPI weights. One can see that heating costs are constituting quite a large share of the total income of households. So it really makes sense maybe not to incentivize households to buy apartments where your sort of say BBM adjusted for heating costs would be larger than if just for the mortgage.
Great, Andres. And it's 6 o'clock, Jaime, so we are all curious to hear your answer, but you keep in mind that you stand, your answer stands between, between the panel and the get-together, and also I have many more questions which I will ask there, so be brief.
Because one of the aspects of the policy is to fight speculation, and I have two facts. One is that the percentage of owners that are like big real estate investment funds is really tiny. I would say less than 5%. And at the same time, what we are doing is hurting like the working class significantly through their savings. And the second thing is that what you want to introduce is competition as much as possible. And some of this competition is important to have the big real estate investment funds because they have firepower. Not everybody has like 100 million euros to to convert an office building into residential or build to rent or doing construction. So I don't see that's the way to, you're creating much more problems at the same time. And, yeah, keep it there. Yep.
That was great, informative and short. And yeah, I think, I don't know whether there's going to be a wrap up, but anyway, thanks for the inputs, thanks for the discussion. And I'll be sure to ask more questions when we get together. Thank you very much.